now facing major structural changes related to aging, digitalization, greening of the economy. But more importantly at the moment, we hesitate between uncertainty, unpredictability, unexpectedness, the unknown. And with all that, we have to deliver on our mission, price stability. So if you're interested in those issues, come to the ECB Forum in Sintra. We will debate all that and more.
Good morning and welcome to Sintra. My name is Wolfgang Preußel. We look forward to 2 days of insightful and inspiring discussions. But before I give the floor to our speakers and to our moderator, Claire Jones, I would just like to clarify the media policy. All sessions and panels during the forum that happen here on stage are live streamed and are on the record and can be recorded upon. All informal conversations that happen on the sidelines, the conference venue, coffee breaks, lunches, dinners, etc., are off the record. Similarly, all other informal conversations not taking place here on stage. But now, I would like to hand over to Claire Jones. Claire, please.
Good morning, ladies and gentlemen. Welcome to the ECB Forum on Central Banking. My name's Claire Jones, and I will be your moderator for the next 2 days. Central bankers and economists are navigating an uncertain era where historical regularities can no longer be taken for granted. Policy, many commentators say, must be made with greater humility, clarity and flexibility. Officials then must aim to boost growth while grappling with momentous change. Our first session is going to look at one area where there's been an awful lot of change, sped up by recent shocks, and that's the euro area labour markets. It's going to be chaired by the ECB's Vice President, Luis de Guindos. Straight after, Frank Elderson, ECB board member, will look at how households respond to changes in interest rates. I'd now like to invite onto the stage Mr. de Guindos and the panelists. Thank you.
Hello.
Benjamin. Thank you very much, Claire. Good morning to everyone. It's a pleasure to have you here and to be back to Sintra. And we are going to start with the labor market. The labor market perhaps has not attracted a lot of attention lately. Perhaps because the performance of the labor market has been quite positive. If you look at the unemployment rate in the euro area, an all-time low since the incorporation of the euro, record levels of employment, but all of us, we believe that this is a key element in order to improve the performance of the general economy. In order to analyze all these aspects, we have Benjamin Schäfer, professor from the University of California at Berkeley, and you have made a rich contribution, I have to say, to the analysis of the labor market, and it covers, among other topics, the labor dynamics in both the euro area and the US, the role of labor hoarding and the retention schemes, the importance of labor market institutions and the regulation of the labor market, and demographics and immigration. But before going to give you the floor, Benjamin, some simple housekeeping rules. Benjamin, you will have 20 minutes to present your paper. And afterwards, our second speaker, that is going to be Nicolas Fuchs-Sandel, president of the WZB Berlin and professor of the Goethe University. And you will have 10 minutes to make your remarks. And afterwards, Benjamin, you will be able to react to the comments made by Nicolas, and afterwards, we will open the floor for everybody. So without further ado, Benjamin, you have the floor, 20 minutes.
Thank you. Right. Thank you very much for the kind introduction. Thanks for having me. And I really look forward to reflecting here on links between European labor market institutions and European competitiveness. And I'm an economist that focuses on macroeconomics and labor economics. And what I try to introduce and revive is exactly that link through the novel channel of what I'll call labor market dynamism or business dynamism that generates a new link between labor market institutions and European competitiveness, macroeconomic performance. So let me jump right in. And in the spirit of the Draghi report, or unfortunately, the next slide is not coming up. I'm very sorry. Wonderful. Thank you. It's going to be a comparison that I'll cast as a transatlantic gap in macroeconomic performance, GDP per capita, where I'll put the United States in the spirit of the Draghi report and last year here in the forum, Antoine Bergot at 100, and then plot European macroeconomic time series as a fraction of the US outcome. Now, GDP per capita, post-war, post-World War II, we've seen catch-up growth through the 1980s. That's when the debate of eurosclerosis, which is in the title of the paper, has started. We settled in at about a 20% gap since the 1980s, and then somewhat worryingly, this gap has widened to about 30% recently and seems to be on a downward trend. Of course, GDP per capita is a story of, or can be decomposed into two margins. One is labor productivity, GDP per hour worked in Europe, that has actually grown a bit longer than GDP per capita through the mid-90s, but then also slowed down to about a 20% gap, and the rest of it is accounted for by the fact that we as Europeans work a bit less than in the US. Now, of course, this has sparked concern and policy concern specifically. This is from the Draghi report last fall. Let me just highlight some buzzwords over here that have been linked with the underlying dynamics of TFP, the growth and capital deepening that we're missing in the United States. There's an innovation gap, particularly in advanced technologies, stuck in static industrial structures. We don't have new companies entering. There's a lack of dynamism, particularly in the tech sector and in emerging technologies. That's an extensive challenge. And other observers agree. For example, growth has been mediocre, deteriorating compared to the United States. We kind of focus too much on existing technologies, large firms rather than new firms, external finance is missing, equity finance, higher investment in R&D, and then growth will come in those sectors such as tech. And we also miss production innovations. We're falling behind the US in R&D spending, new products, and we lack the dynamism. Now, these two quotes are not from fall 2024. The first one is 20 years ago. It's the Sapir report on European competitiveness. The second quote actually is 40 years ago. It's Herbert Giersch's infamous eurosclerosis piece, October 85, and the Financial Times article in January 1905. So these debates are old. The symptoms are also relatively old. This is a laundry list that you see in the paper. They show up in various forms across policy reports and academic papers. And of course, the initial symptom of the transatlantic gap was glaringly related to labor market institutions because there's high European unemployment that focused the attention to institutions such as collective bargaining and unemployment insurance. Now, just in a simple time series, this is high European unemployment that was high in the 80s following the shocks of the 70s, stayed high, stubbornly high throughout the 90s, and then fortunately started to come down towards the end of eurosclerosis in the late 2000s. And then, of course, the global financial crisis hit, pushed up unemployment again, and now we are, as Luis de Guindos mentioned, we are on a good trend towards record low, at least compared to post-80s unemployment level in the European Union. But it's still high compared to the US economy, of course, which is the black line over here, where unemployment rises and then quickly falls. But indeed, we are on a good trend in terms of the unemployment measure. Now, the end of eurosclerosis here, famously, we thought we are at the end of eurosclerosis, at least when it comes to the measure of the unemployment rate. In the bottom right corner, you see a 2009 article by Tito Berri and Garibaldi that says we are beyond eurosclerosis. We figured out how to improve macroeconomic performance, at least when it comes to the unemployment transatlantic gap, US versus Europe, and indeed long-term unemployment has come down. Now, what about the other outcomes that we now link with this transatlantic gap in macroeconomic performance, innovation, TFP growth, capital investment, startups, tech, and GDP per capita optimally? These time series that I started the paper with. Now, where should we find the sources of that gap? And here I plot highly imperfect indices and time series thereof of three markets: financial markets, product markets, US versus Europe, and then the labor market, as you might guess. And in terms of financial markets, arguably, while more work remains to be done to, for example, have reduced capital market fragmentation and have deeper venture capital and equity markets in Europe versus the US. Europe is the blue line, the US is the orange line. We've converged on that dimension much more so. Same thing on the product market, then in the labor market, where arguably Europe and the United States, if anything, have increased the gap in terms of institutional rigidities or features. Of course, institutions have a purpose. We've deliberately set up the European model with strong labor market institutions, labor taxes, employment protection regulations, co-determination, where workers share formal voice in corporate decision-making, or collective bargaining. Now, these are the four example facets of European labor market institutions, where you see in many of those, Europe has actually become more rather than less different from the United States. Now, this is, in a sense, a paper in a nutshell. We know a lot about our labor market institutions, such as the ones that I just described, affect macroeconomic performance through a relatively narrow link. All of these features, we know how they affect the unemployment rate and perhaps wage levels or wage rigidities. But we don't have a lot of evidence on how these labor market institutions shape all the other new facets of eurosclerosis, arguably, and that's what I focus most of the paper on. So this is the standard link, the old view. We know a lot about unemployment, employment, wage levels, but that new view that are highlighted in the paper works through what I call dynamism, and what the frontier literature in macroeconomics and labor economics would call, for example, labor market dynamism. How much are we willing to reallocate between growing and shrinking firms or sectors, or reskill, or equivalently, on the other side, business dynamisms. How can employers and firms restructure and adapt to changes in light of European labor market rigidities? In a sense, this is what I highlight in the rest of the paper as a link on which we know much less, but that I try to convince you, and in the paper there's much more evidence on this that might account for a lot of the transatlantic gap. So let me briefly dwell, but then move quickly to that new view, because I guess it's the new view, on the old view, and focus on unemployment. You've seen the time series before. Arguably, of course, Europeans' unemployment level is at a record low. A lot of heterogeneity remains and perhaps work to be done. We know that, but we're on a good trend over here. And in the paper, there's much more that I do using new microevidence on regional heterogeneity. For example, the age dimension, how well have we done in terms of youth unemployment, which, let me just show you here. In most countries, the US is the gray bar. Youth unemployment, for example, stays high. And we still know that labor market institutions play a role in those labor market disequilibria, in a sense. And in the paper, there's much more, but as I promised, I'll move to dynamism. Now, you might recall the dynamism debate from the perspective of unemployment versus employment. That's what we've traditionally focused on, how to bring down unemployment. And a canonical measure of dynamism in that old perspective is to ask, for how long have you been unemployed? So here we ask the unemployed individuals. Here in the US, that's what I start with. For how long have you been unemployed? In the United States, only about a fifth, say 20%, that it's been more than 6 months. Now, that's a long-term unemployment measure that the BLS, the Bureau of Labor Statistics, collects. They don't even collect longer measures than that, and the green bar is short-term unemployment, less than 6 months. And only Denmark and perhaps Norway come close in Europe, and a lot of the other countries have much longer unemployment spells. And that's a traditional measure of labor market dynamism. And in Europe, of course, we measure much longer spells. The purple line here is unemployed for more than 2 years, so arguably there's a lot of unemployment, long-term unemployment left even in Europe. The green line on the right panel here is the long-term unemployment rate, more than 6 months. One way to assess that transatlantic gap is to also plot overall unemployment in the United States. That's actually higher than long-term unemployment itself in Europe. So there are more unemployed, long-term unemployed individuals in Europe, in aggregate at least, than there are total unemployed in the United States. But that's the traditional measure of labor market dynamism. I want to move to kind of the labor market dynamism and business dynamism that has more plausible links with the macroeconomic performance indicator that are at the top of our mind, at least since the fall of 2004 and arguably since 1985. Now, to measure this in the traditional view is to just ask how quickly do you get reallocated to employment. On the x-axis here, I plot the unemployment to employment transition probability at a given month. In the United States, within a month, 25% of people found another job if they are unemployed. And on the y-axis, you see the probability that you lose that job again. So the US labor market is very fluid. You move in and out of unemployment very quickly. And we all know that the European labor market, this is updated in a sense on Blanchard 2006. Here, we're still in this relatively non-fluid, sclerotic, if you might say, labor market where unemployment spells are much longer. We just saw this. But they also get to keep your job for a long time. Now, you can also take a look at another y-axis, which is a new view. You keep your job for a long time, but you don't have to wait until you become unemployed. The European labor market, and compared to the United States, is actually also sclerotic or non-fluid from the perspective of employment to employment transitions. Once you have a job, you kind of stay put there, rather than moving to the next opportunity into the growing industry. And on the y-axis here, I plot the probability that you switch employers. And Europe, just as it's non-fluid in terms of the other dimensions, it's also relatively sclerotic on that margin. Now, let's switch gears to the 95% of workers that already have a job and ask how they interact with labor market institutions, rather than the 5 or 10% of individuals that are unemployed. How many of us have been on the same job for at most a month, a year? In the United States, that's about a quarter. In European economies, depending on where you look at, it's less than 10%, less than 5%, less than 3% in some of these cases. So new jobs and dynamism you already see in the simple time series. And the flip side of that is a lot of us in Europe have lifetime jobs. The black line is jobs that have lasted 20 years or longer, which in the United States is about 10% or less. In many European countries, it's 20% or more than 30% of people haven't switched jobs, have been in the same job for more than 20 years. Now, why does that matter? Well, it's going to generate growth, as I argue in the last part of the paper. But before moving there, I want to quickly point to the kind of symptoms of job mobility and fluidity that Europe does have. Here, I'm going to add fixed-term jobs. And I'll call that bad dynamism in Europe, where kind of you're forced to leave your employer because the contract ends. And that's an evasion response to strong labor market institutions, of course. Now, those have been on the rise. That's the black line over here. 14% in Europeans' workforce are on a fixed-term job, 12 to 14%. And a lot of heterogeneity across countries, of course, and that has accompanied the decline in unemployment. So in a sense, perhaps we don't know the answer to that definitively. The rise of dual labor markets have facilitated perhaps also, or at least accompanied the decline in unemployment. You see this through a lot of other margins, part-time jobs which are just skipped over. You see evasion of collective bargaining and so forth. But I want to move to the good type of dynamism that arguably is linked with the macroeconomic performance indicator with which we motivated the talk, I guess. And I'll start with labor market dynamism. And I'll first ask, why should we care about labor market dynamism? Much more on the paper. But one perspective is, let's plot on the x-axis the probability that I switch jobs here at the A level. In the United States, that's about 10% of people switch from year to year their job directly without ever becoming unemployed. Wage growth over the career of American workers is large. On the y-axis, it's 0.75. You grow your wage growth over your career life cycle by 75%. The more we switch jobs, as we go to the left, we see Europe come in again, and we see that facets of lack of labor market dynamism show up as a decline in wage growth. Now, wages reflect productivity of a worker, and hence that's already one obvious link that literature has established between labor market dynamism and productivity at the individual level. You see the same pattern at the macroeconomic level, and now rank countries on the x-axis by the same measure, and now put economic growth on the y-axis. And you see the same slope. This is the average annual growth over the last 10 years, 2010 to 2019, before COVID. It's a symptom of a growing economy to have dynamic labor markets in which employees switch between different companies, move up the job ladder, for example. In the paper, I discuss the plausible causal links between these and discuss, of course, also identification problems, which is kind of things go both ways, they're omitted variables. And the literature has linked these dynamics with, for example, population aging. We know that younger people drive labor market fluidity. And across US states, you see that states that have become less young, have become a bit older, you see dynamism shrink and growth also shrink. Of course, many things happen when societies become older, but that also speaks to probably challenges that we'll face and maybe discuss today, which is aging in the population. Now, which institutions affect labor market dynamism. And I think it's difficult to not rethink many of these institutions through the lens of labor market dynamism that we usually linked with the effect of unemployment insurance, active labor market policies. Employment protection specifically might affect labor market dynamisms through ways that we don't understand well, but if you ask a European worker, why don't you switch to a better paying employee? Here's what they tell you. That's indeed what we did to German workers, iron quarters. Why don't you switch to a higher paying job in Europe? And the main answer German workers give you is, my current job, the top bar over here, about 40% of workers, 45% of workers tell you my job is secure here. The next job will pull me down in terms of seniority and hence employment protection. The next job is less secure than the current job. Now, therefore, we see lock-in effects of these European labor market institutions that stifle labor market dynamism, the good kind of labor market dynamism that we know is linked with macroeconomic growth at the individual worker career level, and plausibly also all the benefits that we want from a dynamic economy. This is a laundry list of my attempt to rethink these old labor market institutions that receive very little attention these days compared to the height of high European unemployment. Employment protection, typically increase in seniority. Probationary periods mean that in the next job you can get immediately fired without cause. Last in, first out rules formalize your protection in the firm by your tenure rank, by your seniority within the company. If you switch jobs, you're at the bottom of the ranking again. Severance pay, for example, often mandatory severance pay that exists, for example, in Austria, used to be linked to tenure. And you lose that opportunity to have high severance pay once you switch employers. Austria has reformed its labor markets to permit you to carry that seniority severance pay as an account with you, make it portable. Wage dispersion is compressed in Europe. What are the benefits of switching? I have some research on German job searchers, employed job searchers, that indicates that often German job searchers, at least, perhaps in the US, there's some follow-up work, they don't know the benefits of job searching. And if you tell them that there are wage growth expectations you should have if you switch employers, they seem to be more willing to switch jobs. Now, non-compete clauses, of course, are part of that suite of labor market institutions that prevent job switching. More research is needed there. But for sure, short-term work and labor hoarding policies are institutions that lock you into your current job because you get your large fraction of your previous salary without having to come in at the same amount of hours, of course. Now, but the missing debate is, here we highlight institutions that stifle labor market dynamism. You might also want to ask, what are the institutions that promote proactively labor market dynamism? And that debate we for sure don't have. Kind of call this in the paper active labor market policies for the employed rather than the unemployed. How can we generate dynamism on that end? So that's my attempt to talk a bit about labor market dynamism. The second facet of dynamism that I think we usually don't associate with the labor market institutions is on the employer side. And that might seem to be far removed from labor market institutions, business dynamism, restructuring, operational flexibility. But I think if you start looking again through that list, and if you talk to employers, and I'll cite some evidence, a lot of that dynamism on the business side, especially the kind of dynamism that, say, in the Draghi report and 20 and 40 years before, what is the problem? You can point back to labor market institutions. So one facet of this is dismissals. That's the most extreme version of business dynamism. If you restructure, dismiss some workers. Think the metaverse in Facebook. In the United States, about 1% of workers become unemployed through a layoff or dismissal in a given year. In Europe, essentially, that quickly goes towards zero. So dismissals are incredibly rare in Europe. You cut employment by not hiring, or you offer some other benefits and kind of keep these workers around. In fact, often you have to reassign them within the company rather than dismissing them. Now, what are margins where the labor market institutions obviously constrain operational flexibility? It's dismissals. For sure, that's the direct effect of employment protection. That's their purpose. But actually, European labor market institutions even influence how to hire, say, works councils in Germany, or whom to hire and how quickly to hire. Adapting job titles of incumbent workers that continue to be in your company is difficult due to employment protection and co-determination rules, for example. Now, these constraints arguably bind particularly for industries that depend on dynamism, industries and activities. Now, let me walk you through some existing examples, and much more research is needed here. That's particularly timely. What about ICT, information and communication technologies? In the first wave of digitalization in the early 2000s, let me show you two bars here. For industries that were heavy in ICT, you saw a large increase in worker relocation, dismissals and hiring, shifts between industries and employers. Now, don't worry about the y-axis, because I'm going to show you the same increase in relocation that happened in low ICT industries in the United States. So clearly, if you can't relocate, that's going to be very difficult. Now, do we see, therefore, ICT and digitalization be less pronounced in countries that have more rigid institutions, such as employment protection? X-axis is an index of employment protection. The US is at the very left. You see the most, for example, here, servers per head in the early 2000s over here. And you see this almost too good to believe ranking of countries by employment protection for all measures of ICT. Here for ICT spending as a share of investment, and for all of these measures that are plotted. Now, this is about capital markets and venture capital and equity markets. Was it about employment protection? You can also plot venture capital as a share of GDP, and you get a very similar relationship. So that suggests actually that this dynamism view of labor markets on the business dynamism side and labor market dynamism sides would shed new source on that transatlantic gap, particularly in the regions and the areas that we've highlighted at the beginning of the talk. Now, there's a fatalistic view. Are these fixed institutions? And is it a comparative advantage that's ingrained in the European model? That would mean inevitably we lag behind in these highly dynamic industries and activities and occupations. Or could we reform the European model in a way that makes it easier for these dynamism-dependent activities to succeed? Now, we already have, within the European model, some carve-outs for labor market institutions and regulations. For example, small firms aren't bound by employment protection as much as large firms. Some employees, probationary period, fixed-term jobs, or high-level managers are not bound by employment protection rules. Maybe we can rethink such carve-outs also for the industries that are so urgently on our mind. And of course, more research is needed, and institutions always entail a trade-off. They are there for a reason. But this is my attempt to conclude on time. There's a graphical version, which is the graph that I started with. Rich links between labor market institutions, with all of the indicators of macroeconomic performance through mechanisms that we can dub dynamism. And this is the lengthy conclusion. Thank you very much for your attention, and thanks, Nicola, for the second talk.
Thank you very much, Benjamin. Nicola, it's your turn.
Thanks a
and
lot.
You have adjusted perfectly.
Waiting for my slides. So thanks a lot for giving me this opportunity to discuss this really broad and thought-provoking paper. So I will try to give a very quick summary and provide you some additional evidence to what I see as being the main point of the paper, namely that labor markets matter for growth in Europe and beyond, of course. So these, on the left, you see the same graph that Benjamin showed before, just expressed differently. So since the early 2000s, we have been experiencing relatively sluggish productivity growth in Europe. So in red, you see the US, and in blue, the euro area. And at the same time, what you see on the right is that we had lower investment in new technologies in Europe than in the US. So again, the US is in red, and then you have France, Germany, and Italy, and this is IT-related capital stocks. So clearly, US firms invested much more in IT capital. So at the same time, the unemployment rate, thankfully, has largely been under control and is at almost record lows nowadays in Europe. So the focus of policymakers and researchers alike shifted from labor market institutions to other institutions, so for example, innovation policies and capital markets. However, Benjamin argues forcefully, and I would say convincingly, that labor market institutions still matter. So in the 1990s, many countries reformed their policies targeted towards unemployed individuals and thereby successfully brought down the unemployment rate. Policies targeted towards employed individuals were largely left untouched. But in periods of substantial structural transformation, these are policies that matter for growth. So policies like employment protection regulation or co-determination, they protect job matches. And for growth, and when you have a lot of technological change, you need some kind of experimentation within firms or across firms. And for that, especially job-to-job transitions are really crucial. So in our period that we are in, I would say job transitions, ideally direct job-to-job transitions or through short periods of unemployment, are really an engine of growth. And Benjamin showed these correlations with growth, with wage growth on the micro level and with macro growth as well. So how different are the institutions in the US and Europe? I'm sure you all know this graph here plots the unemployment rate from 2018 to 2023 in the US in red, and then in Italy, France, and Germany. And clearly, we all know that in the US, in recessions, firms let go of workers, and then later on, they rehire the workers or they hire new workers, while in Europe, we focus on policies that maintain worker-firm specific matches, so for example, on short-term work. So which policy is more conducive to growth? It really depends on the times you are in. There's a very nice paper by Hirschbein and Kahn that show that firms in regions that were more affected by the Great Recessions, they used the recessionary layoffs to increase permanently the skill level of their workforce. They subsequently invested more, and they subsequently had higher wage growth. In Europe, by contrast, we focus on maintaining firm-specific human capital, and this is very beneficial in stable times if we just have temporary shocks. But it's not conducive to technological change. And in ongoing work with Chiara Lacava, we analyzed the firing ban that was imposed in Italy from March 2020 to October 2021. And we find, similarly to the US experience, that firms that were less affected by the firing ban, they had more separations, but they also had more hires, and they used these hires to increase the skill level of their workforce. So before I showed you, and I didn't mention that, that the difference in labor productivity between the US and the Euro area grows specifically in recessions, and I mark here the Great Recession and the COVID period. So it seems like the US policies make it easier to use a recession also as a period of restructuring and then to spark future growth. So let me take a step back and discuss the two main challenges that I think we nowadays face in European labor market. The one is the one that Benjamin mentions, namely labor market dynamism. And he showed you indices of employment protection. I want to give you some different evidence on that comes from the International Social Survey Program. So here you see that Americans perceive it as easier to find new good jobs. They are less worried about losing their job. And they have also a higher probability to engage in job-to-job search. So this is all in line with more flexible labor market institutions, as Benjamin explained. It could also indicate almost a different attitude towards labor market that you see in workers in the different areas. And here is more evidence on that. So Americans are more likely to say that upon unemployment, they would be willing to accept a job that requires new skills. And they would be willing to move within the country, which obviously in the case of the US means much larger distances than in most European countries. So what I want to caution is that from my own work also, we found that living under very different institutions also eventually affects culture. And it might be that even with reforms of labor market institutions in Europe, it would take some time to generate the same dynamism that we see in the US. And the second main challenge that we face in European labor markets, and that is less discussed in the paper, is that we will likely have increasing labor shortages due to decreases in labor supply. So the number of individuals in the working age population is predicted to decrease significantly in most European countries over the next decade. And here I show some predictions from the UN. And the predicted decrease is more than 10% in Germany and Italy. And on top of that, I've shown in previous work with Alex Bick and Adam Blandin that also Europeans have decreased the hours worked per employed person quite significantly over the last 2.5 decades. For example, in the case of Germany, by 4 hours per week. We did have increases in employment rates, but they were not large enough to overcome that change. So this comes on top of the demographic pressure that we are experiencing. So we should really think that labor supply will decrease in Europe over the coming decades. So let me link these two. So the decrease in labor supply is likely no good news for labor market dynamism because it increases the bargaining power of workers and unions who are in favor of more labor regulation, and rightly so, this is their job. At the same time, we are in the midst of a period of substantial structural change. So what is the way forward? And I think Benjamin only alludes to that, but here I would really think we need more creative thinking. So something that we might want to think about more is to have a dual system of labor market regulation, where we want to keep the job protection, especially for low-income earners, that we really value in Europe, the protection that we provide to low-income earners, but at the same time, create more dynamism for high-income earners who are the ones who can live with income risks more easily and who have the skill sets that we use to make that we need to make good use of the new technologies. So last, let me give you some quick evidence on where we stand in terms of labor market fluidity and technology adoption nowadays, looking at the case of the adoption of generative AI, which is likely the technology of our days. So to get some evidence on this, we just fielded an internationally comparable and representative survey in the United States and 6 European countries. So that survey was in the field at the end of May and beginning of June, so I show you here some very first evidence on that. What we find in this survey is that the share of workers that use AI is at around 36% in the US, and it's lower in all European countries. In Germany, for example, it's 26%. In France and Italy, it's lower than that. Not only are European workers less likely to use AI at work, they also use it less intensively if they use it. So here on the x-axis, you see the same data that I showed you before, the share of workers who use generative AI. And on the y-axis, you have the share of the users who use this more than 1 hour per day. And you see how Europe lags behind in both dimensions. So this is just rare usage. I think the real issue is like how good use do you make of that, and that is what we still have to learn. But it gives some indication that the US is faster in adopting this new technology. And here I created this graph that replicates basically the graphs that Benjamin showed for computer adoption in the 1990s. So here on the x-axis, you have the Employment Protection Index from the OECD. And at the y-axis, you have US AI usage at work. And you see this same negative correlation that you saw before. So I really want to caution, these are just 7 data points, just 7 countries. And there are probably a lot of unobserved third variables that also correlate with that. But somehow it gives this picture that we have a similar situation as we had it with computer adoption. And I think we could learn about what we learned from back then. How can we make better use of these technologies? So let me conclude. I think Benjamin starts out his paper with really saying we have sluggish productivity growth and also low rate of investment in new technologies in the euro area. So what are the reasons for that? And he falsely argues that we shouldn't only look at innovation policies and so on, but that labor market dynamism matters. So it's really also the creative destruction of job matches, especially at the high level, that we need to make good use of new technologies. And employment protection prevents risky and disruptive innovations. So what are the implications of the paper? I think they are threefold. So for policymakers in general, I think the implications are not to lose sight of labor market reforms and to focus especially on encouraging job-to-job transitions and also continuous learning, which we will need if we have a lot of new technologies. For central bankers, so the majority of the audience here, I think the paper really cautions that there's no easy way out of low potential growth in Europe, and that we could expect a rising bargaining power of workers, which could also lead to inflationary pressures. And for us researchers, I think the conclusion is that we really need much more causal analysis of the role of labor market institutions for growth and innovation. And also we need more creative thinking of how can we reform labor market institutions such that on the one hand we create more dynamism, but on the other hand we keep the social protection of workers that we very much value in Europe. Thanks a lot.
Thank you very much, Nicola. I don't know whether, Benjamin, do you want to react to the comments? Because I think that you have coordinated. I saw that you were talking last night.
And this morning on the way here. To the following degree, I sprinkle throughout the paper this idea that, well, more research is needed, as Nicola mentioned. And had I known of Nicola's discussion before, I would have said, well, this is the kind of research that I think we need looking at AI and also pointing out AI adoption across countries. I think this is fantastic. Thank you very much, and seems to extrapolate the time series to the present day topics. Yeah.
Very good. I will take advantage of my position here, and I'm going to ask you a couple of questions to both of you. The first one is, well, we have a lot of debate and proposals in Europe about the capital market union, but we do not hear much about the labor market union. Do you think that it would make sense? Or perhaps, whenever, we talk, I see Valdis Dombrovskis there, when you talk about regulation in Europe, you have to be careful, huh? Because perhaps, instead of a race to the bottom, it will depend on the benchmark. What do you think? Do you think that it would make sense?
I think if we have discussion of joint labor market institutions, then it's mostly about the European unemployment insurance, and I think this could be very valuable if we have large shocks, as we had it in the euro debt crisis and so on. I think in the spirit of what Benjamin presented, we should think also of these policies that encourage job-to-job transitions, and there I would say the state of the labor market institutions is quite heterogeneous across European countries, and I'm not sure I see so much benefit of unifying that, rather than maybe talking more about what are the experiences, what can we learn from each other, what works well, for example, in countries like Denmark that have more flexicurity, and in which sense can we use that in other countries. And there I think we have to be careful, because obviously it's not only the labor market, it's the entire systems that have to fit with each other. But I think a more European discussion about these issues would definitely be valuable.
Benjamin?
I'd agree with that. While catching up on high European unemployment in the 80s and the 90s, I read a couple of papers, and there seemed to be this idea that we all know what we should do about high European unemployment, but the problem is political in a sense. I think Jean-Claude Juncker said, well, we know how to solve the unemployment problem. The problem is we don't know how to get re-elected afterwards. I think here it's the case where we don't necessarily know what we can do to make European labor markets more dynamic, although there are some kind of good deals where you say, well, let's let you keep your protection, but you get to move with your job protection to the next job, and there's a way for us to make employment protection not stifle dynamism while maintaining protection for the worker. So I think these are the win-win solutions that we could explore, whether on the European level or the national level. That's an open question, but there are some countries like Denmark or Sweden that seem to have more dynamism than others. I think we can use the European laboratory to learn from each other in a sense.
Very good. And my second question is about immigration. Immigration and the influence and the impact on the labor market. Because, for instance, it's quite impressive the case of Spain. A lot of immigration flows, and the evolution of the labor market is one of the best, or perhaps is outperforming the majority of the European markets. What do you think about the impact of immigration from the perspective of the labor market, for sure?
I think we will need immigration. So I presented these figures on the decrease in labor supply, and it's going to be a real issue in many of the big European economies. And so one way to counterbalance is immigration, but at the same time, we have to become much better in integrating immigrants into the labor market. I think you are probably better there in Spain already than we are in many other European countries. It might be a language issue, but there might be also other things that we can learn then from other European countries. And obviously, we all know that it brings a lot of societal challenges to integrate immigrants more generally into the population, to integrate the children into our schools, and to make immigration something that is accepted by the broader society. And that, I think, is a common European challenge that we are facing, that we should not lose sight of. It's a very important issue.
Benjamin?
On top of this, I'm a dual US-German citizen now, so I'd like to think that immigrants, and it's true, it's borne out in literature, are more dynamic and mobile and flexible than native-born workers and employees. So I think you look into research and you find that it's the immigrants often that start businesses, that switch locations. Evidently, they've switched countries and start businesses. And so I think also from the dynamism perspective, that's probably a good bet to make. But I don't have anything else to add to Nicola's fantastic summary beyond that.
Okay, very good. So, I see there, our specialist in the Governing Council on Labor Markets, that is Mario Centeno. We can collect, 3 questions. Mario, Joaquin, and the lady behind. Mario, please.
Thank you for bringing this topic here for us. I still miss a few things in the analysis, and I would like to mention those and see. It's not to blame what you did, because information, data for European labor markets is not abundant, but still we can do a better effort, I guess. So the first thing that I miss is a reference to wages. I mean, you talk about the labor market, but there's no big picture for wages here, and I think it's important for us to bring that into the picture. And from what I see, looking at the European labor market in the last 10 years, there was an amazing change in the European labor markets. Take a few numbers. Mobility. Of the 10 million jobs that Europe was able to gain in the last 5 years, 6 million are occupied by people that work in a country different from the one they were born. This is 60% of all jobs created in Europe on net terms that are occupied by migrants. This is a huge mobility in the European labor market. The European labor market proved quite resilient to those crises. If you look at the Beveridge curve, it barely moved, contrary to the US that shifted out enormously. And that's, again, a matter for efficiency for our labor market. And then I can give you a couple of numbers for Portugal, because we have very good data for this in Portugal. In the last 5 years in Portugal, on average, to create 150,000 jobs per year, the number of hires that we needed to create those jobs were 1.5 million per year. So for each job created, there were 10 new contracts in the labor market. This is a huge mobility. This does not pay merit to the indicators of employment protection that you showed us, and they are not reflected in the reality of the labor market. So my claim, and what I would ask you, is let's go a little bit deeper on the numbers, because that will make a big difference. And in terms of wages, you are absolutely right. The wage gains over a career occur when people change jobs. But again, if you look at the numbers for Portugal, in the last 5 years also, people moving from one job to the other experience an increase in wage of 14%, and those that stayed in the same job of 7%. So this implies that the labor market is working, and it's working quite efficiently so that people can really understand that. So I think it's just that. And I used to praise the labor market functioning in Europe during this cycle. I think we were the first policymakers that did not face the sclerotic labor market of Europe. So that's my
Thank you. Thank you very much, Mario. Joaquin, please go to the point if you're so.
Yeah, I'm very brief. So excellent paper and excellent comment. While you spoke, the German labor numbers, the unemployment numbers came out for June. They're 190,000 higher compared to last year. In my interpretation, I think the simple answer is because of the sluggish economic growth. You ask for creativity. What can we do in an aging society? In Europe, we are living in an aging society. So we are running out of workers. So there are different, let me say, things we can do. I will ask you a very concrete question. What do you think, which role can the minimum wage play in an environment where I think skilled workers are, let me say, they're getting less and less, but also there are so many new jobs are being created, especially in the service sector, on a very low paid level. So I think we have to take into account not only, let me say, the top salaries, also the lower salaries, and what does that mean in your understanding as economists, what we can do maybe on top of that, or is that an essential part, or is it more or less useless? Thank you so much.
Thank you very much, Joaquin. And the last question afterwards, you can reply.
Silvana Tenreiro, London School of Economics. Thank you for the paper, great discussion as well. So when it comes to productivity growth, we have some success stories in Europe, including Denmark and Portugal, whose TFP growth has been as high as the US in the last 15 years. And so my question for both the presenters is really the US labor market our aspiration or the aspiration for Europe, or is there a third way, the Danish or the Portuguese way?
So, Nicola.
Yeah, let me be short, as these are all interesting questions. And so first, I think already the first and the second question shows that we have a lot of heterogeneity in Europe, and that's also what Silvana stressed. So Portugal is for sure in a different situation than Germany is, and that I think could be an advantage. So we could learn from each other, just as you said, and that's also why the US is a benchmark in the paper, and I think it's always a useful benchmark because it's external. But that doesn't mean that we should emulate the system. We have very good reasons to support our systems of protection, but we have to think about, and I think there are ways, and Benjamin is also proposing, like taking your tenure with you, to do that in a creative way that still encourages these job-to-job transitions, because that is something that we really need, and that is very well shown, and even in the Portuguese numbers, this is what brings wage growth, and we have this information treatments also. If you let workers know, it has an effect. So I think that's something we can do much more, and also we academics should think more about. So, and then also in both your questions and the first one, the question on wages is not only what is wage growth, so what is also with inequality, and that's, I think, where our labor market institutions are so valuable, because they really protect the low-income earners, and the minimum wage for sure could play a role in that, and I think the new research on the minimum wage shows that it has positive spillovers of the entire wage distribution, so it's not something to be seen as negatively. I would say overall it's positive. The right level is always the question, but I think it's good that countries like Germany took this up, and yeah, that it has a positive effect on inequality reduction.
Benjamin, anything to add?
Thank you very much. So on the comment of Silvana's and Mario's on the Portuguese case, I think these are exactly the conversations we should be having, which is how come some countries do better than others on some dimensions, what the institutions or the policies or the demographic advantages that lead those countries to do better on the margins that I try to put at the forefront. And I think we don't necessarily know. We see the symptoms, but if I were to ask Mario and Silvana kind of what's the institutional reasons that would make Germany have performed as well as Portugal perhaps in the aftermath of COVID, I think we'd love to know, and research should be done on that. Regarding whether we should become closer to the US, of course, it's an easy comparison because there the gap is large. Personally, I think the institutions are there for reasons, and Europeans choose them. Job protection, being at work in Germany or Europe and Portugal, means something very different than at the US. You have property rights over your jobs, and even in the US, philosophers such as Elizabeth Anderson says, well, kind of this, in the US you have employment at will, in Europe you have democracy at work, and maybe as citizens we prefer these institutions. There's a trade-off. When it comes to the minimum wage, exactly as Nicola said, I think it's a discussion about inequality versus economic performance perhaps, but there's evidence that a high minimum wage, at least in Germany, leads to relocation towards the productive sectors because it releases workers from unproductive jobs that perhaps the workers don't actually know that they would have gained wage gains around the corner in a larger, more productive firm.
Very good point. I move to my right. I see Richard and Ricardo, from Richard to Ricardo. Richard.
Richard and Ricardo. Richard Portes, London Business School. I see this somewhat differently, perhaps, from the UK perspective. Europe has preserved its labor market institutions, strong employment protection rules, involvement of workers in corporate decision-making, robust collective bargaining institutions, generous unemployment insurance benefits, high labor tax levels. That's what the paper pins the problem on. Well, we've got rid of all that in the UK. We have, and I think Nicola's graph showed, we have very low employment protection levels, okay? We have low unemployment, and we have very low productivity growth, right? So what's the story here? Is this labor market sclerosis really the cause of low productivity growth?
Thank you very much, Richard. Ricardo, please.
So Ben, I'd like to put 3 skeptical observations and see how you'd react to them. Number one, and these are all about the tech sector. Observation number one, the birth rate or startup rate in Europe in the tech sector is not very much lower than in the US. It's really in the growing later where the gap emerges. Number two, when we look at non-European and non-US firms, say Korean or Japanese firms that are relocating, opening branches outside of their home country, they hire workers at roughly the same rate in Europe or in the US market. And observation three, when we look at these European firms that really grow, become unicorns, and move to the US, we don't see them shedding workers in Europe. They move to the US, hire a few workers there, but they keep all their workers in Europe. All three observations instead would point to more of a problem in financing, which is that it's easy to start a firm in Europe, but to grow it, you need the financing, you can't get it. Japanese and Korean firms never move to Europe for financing, they move to the US to get venture capital. And three, the unicorns in Europe, what they do is change all of their financing to the US, not get the workers. That is, these observations say that it's really financing the story, capital market union perhaps, not so much that it's the European labor market that's repelling foreign firms, that's asking the European firms to leave and run to the US or even to start. Thank you.
Thank you very much, Ricardo. And I see Vito Constancio there. Yes. So please go to the question directly because we have 6 minutes left. And so, Vito, please.
Thank you for the paper. It's, in my view, too ambitious. Useful, then, particularly in the point where it is well illustrated that the problems of unemployment were at the start in the 80s, the issue about the rigidity of European labor markets. And that has been sorted out, as the paper shows, and that's a useful part of the paper, through fixed-term contracts, part-time jobs, and the waning of trade unions and collective bargaining. All that changed the European labor markets, and unemployment came down. And now, the idea that we still have too much rigidity, and that is the obstacle to innovation, seems a bit exaggerated to me and not proved in the paper enough. The evidence or the arguments are flimsy, and the econometrics is also, because there may be a lot of endogeneity and reversal causation. And if we look to the US, the fact that they had that jump in ICT in the 90s in particular that we missed totally, we see that the major reason was the significant venture capital that exists in the US, and it exists because they have a unified, deep and liquid capital market, and that's what is missing in Europe. Without that deep liquid market, we cannot have really a significant venture capital because they have to recoup the losses they have in many projects with the successful ones that go into an IPO in a deep market. And also, as Ricardo just reminded us, which is very significant, is the fact that the examples of innovative firms in Europe, they go to the US to get capital and to get financing. And that's another illustration that indeed that's the missing link and not so much the labor market institutions in this matter. So my question to you is precisely, one thing that you cannot address in the paper is you find some possible causation that innovation doesn't exist because of the labor market, but you never discuss, of course, and it would be very difficult to discuss what is the weight of the importance of such a mechanism to explain the lack of innovation in Europe. And then my question is, do you think, after considering everything, that the labor market institutions are more responsible for the fact that we missed the ICT revolution and all the rest of it because of the labor market or because of the absence of capital markets?
Very, very good. Thank you very much. Well, you know, we have some rigidity with respect to the time limits, but...
I'll be fast. Richard, the sluggish productivity growth in the UK, I think, is one of the biggest puzzles. And some of the graphs that I mentioned omit also the UK. Often I call it also the euro area when I mention Europe sometimes. I think John van Reenen is working on that now in the UK. I'm looking forward to seeing the explanations he comes up with and the policy implications. But I think the UK is doing better on some of the high-skilled professional services, finance and also tech, than Europe, but it doesn't seem to show up, and that's one of the big puzzles in Europe. Ricardo's comments on the unicorns. The unicorns are rare. It's a small sample size, but I think that's a same thing for the comment over here. You can look at this, and then you can tell a story. That's your alternative story, and indeed the predominant story that I contrast the labor market institution story with. That's the big question. Is it capital markets, or is it, I mean, that's an alternative offering in the paper, is it labor market institutions, which I think comparatively have been understudied. And if I were to press you, what's the causal microeconomic evidence on capital markets leading to innovation and ICT adoption and diffusion of ICT? I think we also largely rely on correlations or the discussions over here.
Thank you very much, Benjamin.
Yeah, let me just add very quickly that obviously it's a multi-causal issue, the low productivity growth. It's not either or. And I just want to stress also that we have been talking about the European capital market for more than a decade, I would say. So we are aware of that, and I think we should keep pushing for it. But the labor markets, I mean, we have been very silent on, and I think I would see it rather as complementary. And yeah, that's a role here too.
Very good point. You know, a couple of questions there and there. You know, I'm pleased to the point and concise. And Andrew Bailey, finally.
Adriana Kugler, Board of Governors of the Federal Reserve. So thank you for a very interesting presentation and comments. I completely agree with what you just said, Nicola, that it's not either or. It's not labor market regulation or product market and capital market regulation. They're complementary. And there's some really good work on this back in the 90s, early 2000s, showing microdata and evidence from microdata, looking at the complementarities between product market regulation and labor market regulation. To the most recent period, I would point to the business formation and how business formation really there was a huge disparity in terms of business formation in the US and in Europe. And that contributed, that can show how business formation really contributed about 3 million jobs in the US. It contributed to sector reallocation as well. So it's not just job to job from firm to firm, it's across sectors at a time when there was rotation from goods to services and back, right? So I think that's an important point to look at recently and how that has increased productivity. The second point is, I think preferences and culture is one explanation you can give to this. The other explanation is that if you look at data from the US moving away from employment at will, you see increases in productivity during that time in the US back in the 1990s. And that can be attributed to specific skills, right? Investments in specific skills, in firms, in sectors that reduces mobility. And so there are kind of two explanations to this. You can go to culture or preferences, if you will, or you can say, well, this is actually due to investments, right? These institutions lead to different investments. And I think that's an alternative explanation.
Please go to the point because we are exceeding our time. And, you know, we have 2 more questions, please.
Dr. Wieland, Goethe University, Frankfurt. 2 brief points or questions. One, you mentioned this, that people don't switch jobs or go to other companies. If I look at Germany or other countries in Europe, one feature is that the large companies have been the same as 10 years ago and as 20 years ago. So there seems to be, say, Siemens, if you have a job there, or BMW, it seems a good idea to keep it and grow there or get promoted there because there's little change in terms of who are the big companies. So that could be one mechanism, how important it is in terms of the demand side from workers. And then in terms of moving to the US and where the growth with the small to large new companies happens, I'm skeptical about the point made about venture capital. A lot of German venture capital, for example, is moving to the US and going there also to German companies who scale up in the US. And I'm wondering if it's not so much profit opportunities, profit and growth opportunities, and things such as labor market regulation, digital regulation, and other things which just make it more risky to scale up here and more profitable and less, you know, in a risky environment in the US. So that would be a channel maybe which helps your point.
Very good. And finally, Andrew,
Yeah,
please.
it's really, really interesting. Very quickly, and this may help with the UK puzzle. I wonder if we're spending too much time on unemployment now, and that actually the answer is to look at non-participation. In other words, unemployment plus inactivity, those who are not in the labour force, not seeking to be in the labour force, as well as those who are not in the labour force and seeking to be in the labour force, because we certainly appear to have seen some shift from unemployment to inactivity. Yet when we want to look at the questions you're rightly focusing on to do with productivity, we need, I think, the broader look, not least because that's going to be determined also by the long-run demographic trends. Thanks.
Thank you very much, Andrew. Nicola?
Yeah, so very fast, we're out of time. On the last point, I mean, the employment to population ratio has been increasing in most European countries. So I don't think we have this shift from unemployment to non-employment. So there is really a shift into employment, and that is good news. It's just not large enough to overcome the other movement that I was pointing to. So let me stress that and leave it as this.
Benjamin?
I would agree. As we increase the employment population ratio in Europe, which has been happening, and unemployment shrinks, I think it's more and more important to look at how to make the employed move to productive jobs. Governor Adriana Kugler, I think you've done work on employment protection in the United States and employment at will that has shown exactly the mechanism that you were too modest to attribute to your own research. You're one of the few scholars that I think has linked US employment protection regulations across states with the outcomes that I try to shed light on over here. And I think we should do more on that on Europe as well. And Volker, your point about European careers inside large companies being maybe the preferred choice, that's exactly what we see in the data. But perhaps that should be viewed as an equilibrium outcome of all the institutions that Nicola and I try to put our finger on, and maybe another world is possible, but maybe not preferable, and I don't want to overstate anything.
Well, thank you very much. I'm going to be very short. I am not as pretentious as trying to summarize, but perhaps the conclusion is that labor markets matter, and they are very relevant. So thank you very much, and applause for all of you.
Thank you.
Thank you very much.
Well, thank you very much.
Thank you. Thanks.
All right. Okay. Good morning. Good morning also on my part to all of you. And I should, I guess, also say good morning, good afternoon, good evening, good night to all those who are following the live stream. I'm delighted to chair this second session of the day in a room that has warmed up intellectually already. And we will discuss a paper, Discretionary Spending on this Cycle and Why It Matters for Monetary Policy, by Paolo Surico, who is sitting here to my right. And Paolo Surico is a professor of economics at the London Business School and many other roles. And to my left, we have Maria Teresa Valderrama, who will be the discussant. And Maria Teresa is head of the monetary policy section in the Österreichische Nationalbank and member of the Eurosystem Champ Research Network. Now, research on monetary policy is increasingly delving into granular details to uncover the heterogeneities within the monetary transmission mechanism. Heterogeneity refers to the different ways that individuals, firms, and sectors are affected by or respond to monetary policy, resulting in varied impacts across the economy. These include, to just name a few, state-dependent heterogeneity, such as those arising from financial fragility, industry-specific differences, for instance, between manufacturing or services sectors, and discrepancies based on household wealth and income. Now, this line of research is crucial for the European Central Bank, as it enhances our understanding of how monetary policy gets in all the cracks of the economy. And as highlighted yesterday by our president and by our chief economist, Phil Blaine, when they presented the conclusions of our strategy review, we base our monetary policy decisions, including the evaluation of their proportionality and potential side effects, on an integrated assessment of all relevant factors. Ultimately, a deeper understanding of the transmission mechanism can improve the efficiency and the effectiveness of our policies. Now, this session's paper contributes to this important field by exploring the heterogeneous effects of monetary policy across sectors, producing necessities versus discretionary goods. And there's no one who can better explain that than Paolo. So the floor is yours, and it is not just the floor, but the stage, because you asked me yesterday, can I please walk around? Because that is the way that I can really impress my thoughts on this audience. So please, the stage is yours.
Thank you.
You have 20 minutes for that.
Thank you. It's a great honor to be here. This is a joint work with 3 past and current excellent PhD students that we are very lucky to have at London Business School. They are really the main driver behind this paper, and Chiara is sitting there in the audience. Michele has a deep knowledge of the theory and the optimal monetary policy we're going to discuss. Natalie and Chiara have a deep knowledge of the microdata, the estimation and the identification that we use, and I have a deep knowledge of the 3 of them. What I want to start with is a quote from Engel. So what we propose here is a new framework to think about business cycle, to think about consumption and therefore monetary policy. The poorer a family is, the greater the proportion of total expenditure he must devote to the provision of nourishment. When income is small, most of it goes to put food on the table, to necessity. The richer we become, the more we want to dine out, we want to buy insurance, we want to buy holidays, furniture, vehicle, and so on, so forth. Although this distinction between necessity and discretionary spending has proved to be very important in many fields of economics, structural change, development, inequality, even quality of the price index, very little has been made as a progress in business cycle analysis. This is surprising because when the Bank of England, for example, among many other central banks, asked respondents, what is your first response to the cost of living crisis? The vast majority of respondents clearly identifying cutting non-essential, cutting discretionary spending out of their budget as a way to respond to an increase in the cost of living. So what we do in this paper, we take a bottom-up approach, starting from granular microdata, plenty of data set, to generate macroeconomic time series. We start from final consumption. There, the British ONS already provide a categorization in necessity and discretionary, but we have verified that this largely corresponds to necessity being goods and services whose budget share decline with income, an income elasticity below 1. Whereas discretionary are goods and services whose income elasticity is above 1. Discretionary is when budget share increase with your income. Example of necessity are food, energy, medical product and services, personal care, insurance. Example of discretionary are vehicle, hospitality, clothing, dining out, package holidays, and so on and so forth. But we want to move beyond consumption. Also look at employment, industrial production, and many other outcomes. So we need to decide how to classify intermediate inputs. We look at input-output table, and the Leontief invert to attribute this intermediate industry to final industry. And this allows us to categorize discretionary and necessity sector. This provides us with a novel set of macroeconomic time series that can apply to all the standard time series econometrics that we know. Time series on consumption, prices, labor market, financial market, and so on and so forth, separated into discretionary and necessity. This is what the data look like. What you see in black is the standard aggregate consumption for the euro area. What you have probably not seen before is the blue line, discretionary spending, and the red line, necessity spending. As you can see, discretionary spending are easier to postpone. This is what really drives the business cycle. Whenever there is a recession, there is a large drop in spending. Wherever there is a boom, there is a large increase in discretionary spending. And this happens across all recessions. In fact, we can do even more and look at the last 3 recessions. Normalize to 0 the start of the recession and ask how much of the drop in aggregate consumption is actually driven by cutting discretionary spending. And in each of these 3 recessions over our sample, we found that 95% of the movement in aggregate consumption is actually driven by cutting discretionary spending. When we move to the labor market, a similar striking picture emerged. The large drop in employment we have seen across each of these 3 recessions is driven by cutting labor demand, by firming the discretionary sector, which are the ones that are facing the largest drop in their product demand. What, however, is less appreciated is that there is a very heterogeneous labor force composition across these 2 sectors. 20% of hand-to-mouth workers are employed in discretionary sector, as opposed to only 5% of hand-to-mouth workers working in necessity industry. Hand-to-mouth workers are defined according to some ECB study, which is workers that live with a level of liquidity which is less than half of their monthly income. This is the beauty of working with micro granular data on the household balance sheet. As you can see, hand-to-mouth workers are much more likely to be employed in discretionary sector and to be at the lower end of the income distribution. When it comes to inflation, however, a different picture emerges. The one that is very volatile is inflation in the necessity sector. And this is true in each and every one of the previous recessions. Particularly striking is the recent episode of inflation. You might think that the black line is the necessity inflation is all what drives the spike in inflation, whereas the discretionary spending inflation is all the one that drives the persistence. You might think, oh, this is just capturing non-durable and services. Actually, it's not. When you see at the top, first you notice the non-durable inflation peaked over the recent episode, and the persistence is driven not just by services, also durable inflation is a similar persistence. However, when in the bottom left chart, we separate non-durable into necessity and discretionary, is evident that it's only necessity non-durable that is driving the spike in inflation. In fact, discretionary and durable contribute to the persistence. And the same all true for services. If we split services into necessity and discretionary, it's only the smaller share of discretionary services that account for the persistence of inflation. Necessity services are relatively flat. What is the story here? What is the narrative? I'm very sorry to bring you bad news. You just got a pay cut. You go home to your partner and you said, maybe that electric vehicle we wanted to buy can wait longer. Maybe that glorious summer holidays in Puglia will have to wait for another couple of years. We don't need the gym membership. Maybe we should not renew the theater seasonal ticket. What you don't realize that every time you make this decision, actually you're undermining the job of waiters in those restaurants, of people that work in hospitality, blue collars that work in manufacturing, ushers that work in theater, trainers that work in gyms. those are the people that are disproportionately affected because they work in the discretionary sectors. And those are the ones that have a high marginal propensity to consume in the economy. This implies that the initial cut in discretionary spending spill over to necessity, and they make the initial recession amplified and much larger. These drive a second round effect that make income going even lower and generate a further cut of discretionary spending, which still amplify the cycle. However, monetary policy can do a lot about this. Monetary policy can short-circuit the discretionary cycle. How? By giving more focus and attention to discretionary inflation. Because by doing that, it closes the output gap and prevent the second round effect, prevent hand-to-mouth workers to lose the job, and therefore prevent the amplification of the recession that is generated by the cut in discretionary spending. I will clarify later on that this has nothing to do with the central bank to having an additional redistributive objective. In fact, this is true because the central bank only cares about aggregate inflation and aggregate output. But it needs to short-circuit this discretionary cycle to achieve better outcome on aggregate variable. And once we are here, we can also use the standard analysis in the European Central Bank for leading indicator analysis. And what we discover that the predictive power of some of those aggregate variables, like employment, prices, dividends, actually are very sectoral, are driven by specific sector. The predictability of employment in forecasting euro area GDP and inflation actually come from the discretionary sector, not from the necessity. And when it comes to prices, the predictability for the cycle mostly comes from necessity price. The same for dividend is only the dividend paid by discretionary firms that is a good indicator of the euro area business cycle. In fact, we go on and generated a very granular series of stock returns and dividend growth by firms in discretionary and in necessity sector, and the ones that are more volatile and change more their stock prices and dividend payment are actually in the discretionary sector. This is all correlation. You may want to look in identified shock, so we go standard here, off-the-shelf monetary policy shock. The first column should not surprise you, is the aggregate response of consumption, employment, and inflation. However, when you separate these into the response of necessity and discretionary sector, you see that for quantity, most of the action comes from discretionary spending. After an interest rate hike, is discretionary spending that gets cut, is labor demand in discretionary sector that gets cut, but it is inflation in necessity, the one that takes the largest hit. This paper fit into a much broader research effort concerted by the European Central Bank and National Central Bank, which I have the honor to contribute to, which is CHAMP, looking at the heterogeneity across country, household, financial condition, and firms in the transmission of monetary policy. This also contributes to another very important research network at the ECB, the Wage Tracker. They look at heterogeneity in wage negotiation across country and sector and how these affect the transmission of monetary policy. This paper tried to contribute, exposed actually after this presentation, to the CHAMP network, and we have ongoing work with Sara, Carlo, and Christian that try to contribute to both, also to the ECB Wage Tracker, how the staggered setting of wage negotiation could account for the recent spike in inflation. So what we have learned so far? During a recession, after an interest rate hike, households cut discretionary spending more. This implies that firms in discretionary sector face an incentive to cut more their labor demand. I didn't have time to show you the response of wages, but this is much more muted and much more symmetrical. It's really this comes from the extensive margin, dropping people, firing people. And the people that are fired tend to be much more likely hand-to-mouth, because this is the higher share of work in discretionary sector. This is important because those are the workers with the high marginal propensity to consume, and therefore are the ones that are going to cut sharply that consumption whenever they lose their job. On the other hand, necessity inflation is the one that is more volatile, is the one that responds more. There's a number of facts. I hope that some of them are new, are intriguing, but the legitimate question is, and so what? What is the role for monetary policy? So what we do here, we build another framework for monetary policy that is based on two pillars. The first assumption, we want heterogeneity in spending. To do that, we have non-homothetic preference on two goods with different income elasticity. This allows us to have households that during booms want to spend more on discretionary because their budget share increases when income is up. And during contraction, they want to cut on discretionary because they are easier to postpone. The electric vehicles, the Puglia holidays, and so on and so forth. Also, we want to respect the feature of euro area data, and we want to give discretionary sector a higher share of hand-to-mouth workers employed there. We show in the paper that these two features, heterogeneity in spending and heterogeneity in the labor force composition, endogenously generate a cyclical labor demand. Firms tend to lay off more hand-to-mouth workers during recession and to hire more during expansion. Everything else in the model is relatively standard. We need sticky price to give a role to monetary policy. We give inattentive household to match the hump shape of the impulse responses. And then we have a standard Taylor rule, except we add an omega parameter. This is a parameter that gives more weight to discretionary inflation, pi d, relative to necessity inflation, pi n. Where omega is 0, you mostly focus on necessity inflation. When omega is 1, you mostly focus on discretionary inflation. What do? We derive the welfare-based loss function. We take a second-order approximation, and we evaluate different interest rate rule by changing omega in the interest rate rule, by changing how much the central bank should focus on discretionary versus necessity inflation. And this is the result that we get. The vertical line represents the percentage change in the loss function. High value is bad, the loss function is higher. Lower value is good, the loss is becoming smaller. What you see as a vertical red line is the weight in the consumption basket of discretionary spending in the data. Let me start by the flat line. This will be a standard representative agent model, or a model in which has hand-to-mouth workers which are evenly spread across the two sectors. In that kind of model, targeting one sector or the other, focusing more on one sector or the other, it doesn't get any benefits. However, in the purple model, we start giving more hand-to-mouth worker to the discretionary sector, as in the data. And you can see that already in that model, focusing more on discretionary inflation, responding more to discretionary inflation, reduce the loss of the central bank. Although the gains are small, which is consistent with all this literature that shows that heterogeneity, household heterogeneity, it doesn't add much to the aggregate outcome. However, in the full model, we have the full interaction between heterogeneity in spending, we're adding now non-homothetic preferences, and heterogeneity in the labor force composition, more hand-to-mouth worker working in discretionary. And once you do that, then you get a much steeper function. Now, focusing more, responding more with the interest rate to discretionary inflation generate better outcome. Let me emphasize, this does not mean changing the inflation target. This means in the same framework and with the same target, the central bank can achieve superior outcome by focusing more on discretionary inflation. Not because of discretionary inflation itself, but to achieve better outcome on aggregate inflation and aggregate outcome. Let me develop further this point with an intuition that really goes into the math of our paper. Before I have showed you one parameter in the interest rate rule, now I'm showing you a parameter in the weight of the output gap in the central bank loss function relative to inflation. Let me start from the textbook representative agent model. Here we get the classical result. Really, monetary policy should mostly care about inflation. The relative weight on the output gap is almost 0. However, the more you add layer of heterogeneity, one after one, until reaching the full model, which is the blue bar, stronger weight needs to be placed on the output gap to achieve better aggregate outcome. In fact, in our full model, the weights on the output gap in the loss function is about 9 times larger as in the representative agent model. Once more, let me emphasize, this is the case even though there are symmetric shocks in our model. This is the case even though in our model, the central bank has no redistributive motive. What I'm saying, that to achieve superior outcome in the current framework, even if the central bank don't care about the redistribution, putting more emphasis on discretionary inflation achieves superior outcome for aggregate inflation and aggregate outcome. And the reason is because the central bank, by responding more to discretionary inflation, can short-circuit the discretionary cycle, avoid hand-to-mouth worker to lose their job because discretionary spending is lower, and therefore avoiding the recession to become much larger. I want to leave with a final message. This is not just the euro area. In the top column is the result for the United Kingdom. Discretionary spending is the cycle also in the UK, and the bottom row is for the United States. Discretionary spending is the cycle also in the United States. Whereas the recession, the one that moves more is discretionary spending. When there is a boom, discretionary spending is the one that picks up more. Discretionary spending is easy to postpone, is easy to shift intertemporally. Which brings me to the final slide. We believe we have focused, there are many dimensions of heterogeneity. And in fact, many that we have not seen, and we believe actually will make the results even stronger. But here there are two that I think has been overlooked in policy and academic circles. Heterogeneity in spending composition, discretionary versus necessity, and heterogeneity in the sectoral labor force composition, hand-to-mouth worker being more likely employed in the discretionary sector. When you put those two together, this generates a powerful amplification mechanism that no one of these heterogeneity on its own can possibly generate. The main takeaway from our analysis is that responding more to discretionary inflation can help stabilize aggregate demand more within the same current target of the central bank, within the same current framework, without emphasizing a separate motive for redistribution. Redistribution matters to achieve better aggregate outcome even when shocks are entirely symmetric and when the redistribution is not a motive on its own. You can interpret our result as a theoretical foundation for a richer, better measure of core inflation. What is core inflation is a broader measure of discretionary inflation. There is actually more necessity inflation than food and energy that the central bank would like to focus on. I have been delighted to be asked to write this paper, and I'm very proud of all the effort we have made. I can tell you that if I knew the pain it would have taken to write this paper, I would have not accepted this invitation. But now that the fixed cost has been paid, we will be super happy to share the codes and the analysis for everyone to take over and continue on this journey. Thank you very much.
Thank you very much, Paolo, also for sticking almost to the 20 minutes, so that was much appreciated. Please, Maria Teresa, the floor is yours for 10 minutes.
Okay. So good morning, everybody. I would like to thank the organizers for inviting me to my slides. Okay. To invite me to discuss this very, very nice paper, a very rich paper. The usual disclaimer applies. These are my views and not those of the ÖNB or the Eurosystem and also not the CHAMP Research Network. I also have a warning that, as also Paolo, he got only 20 minutes, I only got 10 minutes to discuss a really very, very rich paper. So I'm going to, I don't think I'm going to do justice to all the work that has been done in this paper, and I'm going to concentrate a little bit on the things that I think are more relevant. So what is the paper for me? This is my interpretation. I hope I don't fall down from here. So I think that, I mean, Paolo just mentioned it, the way we think about traditional categories of consumption do not take into account that we are all different, that we have different preferences, different incomes, so there's non-homothetic preferences. And as Paolo showed, that has very important implications for how monetary policy is transmitted to the economy, and especially how shocks are amplified in the economy. So what they do is that they propose we will distinguish between discretionary and necessity spending. They act on their words, and they create all this data work on creating categories of necessity, the necessity sector and the discretionary sector for a bunch of different variables. So we have consumption, we have inflation, we have stock prices, I can't remember anymore, but they have a lot of data. And they also do this impulse response analysis to show that they matter how shocks are amplified in the economy. And then, for me, an important part of the paper is that they apply this calibrated theoretical model, incorporate these features that they look in the data, that they find in the data, and try to revisit the design of optimal monetary policy. I think that Paolo was a little bit more cautious in his presentation than what is in the paper, so I have the paper version. And the main features of this theoretical model are, then you have these different preferences in the utility function, you have heterogeneous labor markets, you have this higher share of hand-to-mouth workers in the discretionary sector, and you have homogeneous nominal rigidities. So let me go to this disappearing, and I don't know it by heart. Okay, so the main contributions of the empirical part. Okay, so I'll have to okay, leave it there. So for me, what are the main contributions for the empirical part? So one is that they show this that discretionary spending is more sensitive to the shocks or to the business cycle. As I said, the data work is really amazing, and I think that it is also a big contribution to the literature, and also that knowing that you will share the codes, and also I think that it will complement a lot of these projects that we have in the CHAMP Research Network. But it is also at the same time more evidence that the importance of sectoral data and granular data. And here is again an area where we lag the United States a little bit, like in your US version of the paper, the non-essential and essentials business cycle. I think the data work was better, and here we see again that in the euro area, well, of course we're 20 countries and so on, but still we have to do more work to get this kind of data. Now, from the theoretical part, I will concentrate on these policy recommendations, and basically the idea, and I think Paolo mentioned it also many times during his presentations, is that since these hand-to-mouth workers receive basically this double whammy of, you have a recession and then the demand for their labor goes down, then they are more exposed to output fluctuations, and for the central bank, this output stabilization becomes more important. As I said in the paper, the policy prescription is a little bit bolder than the presentation. They conclude that the ECB should target inflation and discretionary good prices, and it should put more weight on the output gap. And then there are three questions about this. The first one would be whether really the monetary policy should be the one that is smoothing the income loss for hand-to-mouth households. You can think about other policies like the discussion that we had before, labor market policies, some kind of employment insurance or other institutions that are more appropriate. So it would be nice to have, like in your model, to include this at some time of fiscal policy or sometimes unemployment insurance, and see what is the more welfare maximizing. In terms of the output gap, I think that for me, that is the definition of the difference between hawks and doves. So some of the governors will be happy to put more weight on the output gap, and some others will not like that. But of course, the idea of targeting inflation in discretionary good prices or putting more weight on the inflation in discretionary, I think has to be discussed more. Especially, we have a lot, the literature on optimal monetary policy is very rich, and basically it is a very common finding or a very common policy prescription in this model that you should target the sector where you have more price rigidities. Because monetary policy tends to be more effective. And in your case, you say, well, it's not because of more price rigidities, it's because of this amplification mechanism. But we know that despite theory telling policymakers that they should target the more price rigid sectors like core inflation and so on, this is not. I mean, it didn't happen yesterday that we changed the target, the inflation target. But after the strategies, before the strategy, we can start discussing again whether in 5 years we would say that we would think about changing the inflation target. So what do you have to do to convince policymakers that your model is better than the others that have been ignored in the past? I think that the most important thing that you have to do is to bring the model to the data. So you have all this data, and then you have the theoretical model, and you calibrate the model, but you do not show that like the statistical properties of the data that is generated by the model replicate the stylized facts that you presented in the first part of the paper. And I think that also you play around a lot with these optimal policy rules. You showed only one in the presentation, and I really encourage everybody to read the paper because there is much more material than what Paolo showed. So when you're comparing optimal policy rules, I think it is not enough just to switch off a parameter and see what the outcome is, what the welfare outcome is, but you have to look at the model, ensure that the fit of the model that fits the data, then switch off the parameter, ensure against the fit, and so on, so that you can compare welfare outcomes in a cleaner way. And of course, it would be nice and more convincing to policymakers if you did a counterfactual analysis. What would have happened if 2021, when we're doing the last strategy review, there had been a change either on the target or just the weight that you put in discretionary inflation would be better off. And then on a very technical note, a colleague in the OMB is working also on this non-homothetic preference. They're constructing a cost of living index with this non-homothetic preference, and they have developed a methodology that you could include in your theoretical model, and that will give you like this very consistent price index that you can have in your Taylor rule instead of dividing or separating discretionary and necessity. What is missing? Since you are now in the CHAMP Research Network, you cannot get away without having some sectoral price rigidities. We have seen that, especially in the last inflation surge, that those were really very important elements that were driving the inflation surge. And also, there are a lot of papers in the CHAMP network. Here, I citing only the ones that are already working paper published, but there is a lot more coming that show that this sectoral price rigidities, this heterogeneity, has a big effect on how shocks are amplifying. And also all the literature production networks shows also how shocks are amplified. And I think that will be either a complement that they work with your data, or that you include some of these rigidities in your model. And I think that what would be interesting also is that those channels, you can compare those channels and also see how relevant your channel is compared to the channels that these other authors have shown, especially, and see, okay, would the policy prescription remain the same if you find out that your amplification channel is not as relevant as the others. So I will stop here because I have only 11 seconds, and the rest is just repetition. Thank you. Thank you.
Thank you. Thank you very much, Maria Teresa. Paolo, would you maybe want to respond?
Yes. So thank you very much. This was an excellent discussion. I really appreciate. Also bring me back at the time in which I was working for the Bank of England. I used to go in trouble with the press office all the time. So this was a little bit of a reminder of that. I stand by every single word I said in the presentation. I think they are more accurate than the draft, and we will reflect that. We are not saying this is the only channel. We're not saying that this is even the most relevant. The game that we play was actually try to be as standard as we could, except this interaction of heterogeneity in spending and heterogeneity in the labor market. And the reason is simply because perhaps this is not a dimension that policymakers have much considered so far. And therefore, we wanted to highlight that dimension. In terms of model evaluation, you're right, we don't match impulse responses as we do for the paper on the US, but we have verified that we can qualitatively replicate the magnitude and the shape of those impulse responses. Very good idea in terms of the time series counterfactual 2023, and in terms of heterogeneity, nominal rigidity, may I ask to put back up our slide, because I think I have a table that responds exactly to that. So if I'm able to go back to my slide, I'm looking at the big brother out there that I'm sure can hear and control everything for us. And then I'm going to quickly go to the very back of the presentation. And I wanted to show that one of the maniac Herculean things that we did was even to compute the average probability of nominal adjustment in prices and wages, thanks to the great help of Sarah Holton and the colleague Botelho and al. That have first worked on those data. What you can see is that there is no much asymmetry in wage rigidity between necessity and discretionary sector for wages. However, when you go to prices, if anything, discretionary sector adjusts less frequently. So the nominal rigidity goes in our favor. The reason why we assume no heterogeneity in price stickiness across sector, exactly to show that even in a model in which there is no sectoral shock, in which there is no sectoral heterogeneity in nominal rigidity, even in that plain model, you still have an incentive to respond more to sectoral inflation. If we were to feature in our model even the asymmetry nominal rigidity that the data support, so discretionary prices are more rigid, we will find an even stronger motive to respond to discretionary inflation. But we thought it was a cheap shot, so we went for let's stack the cards against us.
Paolo, if you knew how many people have already asked for the floor, you wanted to maybe wait for some questions.
I was trying to cry them out.
No, sure. No, very good, very good. I was going to ask an ice-breaking question, but I'm not going to do that because I already have too many, and also because nowadays, alas, we have a lack of ice and not too much of it. That having been said, I had a gentleman right there. Please, on the second row, and then I will go to Francois.
Jordi Galí, CREI and UPF. Very interesting, Paolo, as usual. I have a couple of comments. Now, you didn't talk about the type of shocks that were driving fluctuations. So one wonders whether your conclusions are robust, even if you were to condition on each shock. And that would be surprising to me, because if you think about, for instance, the possibility of a cost-push inflationary shock in the discretionary sector, I mean, following your prescription would call for a large reduction in employment in that sector in order to tame inflation, and that would have large negative consequences for aggregate output and aggregate employment for the reasons you said. And the other thing is, in your rule, you allow for this differential response to inflation in the two sectors, but the logic of the model would seem to call for a differential response to employment in the two sectors, or to the output gap in the two sectors, but you don't seem to allow for that. Thank you.
Thank you. I'll take Francois and Isabel, and then we try to answer.
Grazie, Paolo, for this fascinating presentation. If I take the risk to oversimplify your monetary policy message, we could say that your recommendation is that we should focus much more on core inflation, even if fine-tuned, and much less on headline inflation. Hence, two questions. Would you agree with this oversimplification? And B, there is at least one risk, because for households, there is no such thing as core inflation. They look at headline inflation. And so if we focus much more on core inflation, what is the risk of de-anchoring inflation expectations? I think it would be a serious one.
Thank you, Francois. Isabel, and then we take the first round.
So actually my first question was Jordi's question. So my second question is very close to Francois' question. So it seems we all have the kind of the same ideas. So I was wondering, I mean, if I look at your, the dynamics of the inflation of the necessities, I mean, this looks as being driven mainly by energy. So are you asking us to look through energy price shocks, which would not precisely be the lesson that we've learned from the previous inflation surge?
Please.
Excellent. So, all excellent question. So here, Jordi, you're absolutely right. We look at an aggregate cost push shock. But it will be very interesting what you are discussing, which is what would happen if this cost push shock was evenly and asymmetric across the two sectors. We haven't got there. I just want to make the case, you know, this was more the kind of Werning, Lorenzoni, Straub kind of analysis of this sectoral shock. They're saying this is a supply shock that gets propagated through demand. Here we're almost playing the opposite game. This is a demand shock that gets propagated through supply. The point I'm trying to make is that once you start looking at the economy from this new perspective of discretionary and necessity, all sorts of interesting questions come about. We have not looked at what you suggest, but I think it will be super interesting to look at that if my co-authors do not drop me by extortion. Also, the response of the output gap is, believe me, is the first item in our agenda. Is what we wanted to look at, but we were just overwhelmed about all the kind of analysis that we have done. So we want to see, here I'm talking of, so it's a little bit the logic of the standard New Keynesian model that actually you taught me. That actually you want to close the output gap, and then by coincidence, happen this to be inflation targeting. Here, I'm appealing to the kind of same of logic. You want to close the output gap that happens to be the discretionary sector because drives that. But we are definitely going to look at what's going to happen if you change the interest rate response to the sectoral output gap. We have not been there, but it's very, very useful. Regarding core versus necessity. Just to be clear, food and energy represent, and Chiara, please correct me if I'm wrong, around 25 to 30% of the consumption basket, and there is another 20% that comes from other necessity. To a first approximation, we are suggesting that if not necessity, if not discretionary, at least looking at core inflation could achieve better outcome. But for very different reason for the why you have been focusing on core inflation. Not because it's more volatile, not because there is a different rigidity, but to short-circuit this second round effect from hand-to-mouth consumer. So I'm happy with that, you called it, I'm quoting you, simplification, but as long as we understand that is a very, very different motive from the one that we have used so far to focus on core inflation.
Maria, anything to add?
No.
Okay, very good. Then we go to Yannis, and then to your neighbor, and then I have Philip Lane.
Thank you, Paolo. That's an excellent paper. I would say a revolutionary one, but however,
I knew there was a death kiss coming. I could feel it.
As you know, our mandate is consumer price inflation. So we don't have the liberty to choose what kind of inflation we stabilize. But suppose that we had the liberty to do that. As you know, there's a school of thought which criticizes central banks by ignoring the inflation of the poor. And the inflation of the poor is actually the inflation of the necessities. So if we choose in your Taylor rule the weights in favor of discretion rather than necessities, I think that we come out with very strange situations, and the social criticism will become even more intense by ignoring the inflation of the poor. So how do you respond to that?
Thank you, Yannis. You can just give the microphone to your left.
Yeah, it was the same question on communication. How will a central bank communicate to the public that its mandate is to stabilize luxury or non-essential price indexes?
Can I respond? Because it's super important.
Of course you can, but I'm going to look at Philip Lane whether you think your question fits very well or not. You go ahead, and then, you know.
Well, maybe the first comment I have is, over the last 6 years, we've also had the Consumer Expectation Survey, and it just screams out of that survey the non-homothetic point. So repeatedly, we've looked at what the bottom decile, and throughout the deciles, the expenditure shares they have. And this basic issue, which, you know, I think you're highlighting, which is, because we know people work in different sectors according to their skill level, we know the expenditure shares are very different. So, you know, the fundamentals you have here, you know, look very promising. But a bit like the discussant, the question is, during this episode, we also had a lot of fiscal intervention, which I'm sure were all optimal policy interventions, where the fiscal authorities across Europe were targeting more or less their version of necessary expenditure. Now, we always would say targeted. We want it to be targeted, because you could also maybe cross-reference by income level. But if you added optimal subsidies, I wonder what your results would look like. And then the third element is there's another margin, which I'm not sure you have in the model, which is the open economy dimension, because it turns out a lot of the necessities are very tradable. So energy and food, a lot of food is very tradable. And when you have that margin as well, you know, there's, of course, a long tradition of traded versus non-traded. So if you add that dimension, what does it look like?
I propose we do another round of answering.
Thank you very much. Yannis, Silvana, actually yesterday I asked Philip Hartman, can you please ask me that question? Because I would love to clarify. So I don't know whether Philip feed you or this came spontaneously, but this is so important. Let me split into two. You are saying the inflation of the poor, the consumption of the poor. There is a scream out there to focus on that. I get that. I'm just saying the flip side. I'm asking you to look at the employment of the poor. What I'm saying here, we might be perhaps focusing too much on the inflation and the consumption of the poor as opposed to the employment of the poor. Because what's happened with discretionary inflation, discretionary spending, if you look through consumption and inflation, you realize that the poor lose their job. So this is actually monetary policy that short-circuit the cycle to protect the job of the poor. So the narrative we are suggesting, I'm not saying that the consumption and inflation of the poor is not important, but I'm saying that that narrative is missing the employment of the poor, and that is much more powerful transmission mechanism for monetary policy. So let me also clarify this. We have not changed the target of the central bank. We are not saying, I wrote it, but I'm going to adjust that. But I'm standing with what I said in the presentation. In our loss function, the weight on the redistributive motive is actually very small. You don't have to change your loss function. You don't have to change your mandate. Still, you will keep aggregate CPI. But what I'm saying that to achieve better outcome for aggregate inflation and aggregate output, responding more to sectoral inflation would improve that outcome. It doesn't have to be a change in the objective function, in your mandate. I'm saying that to achieve that mandate, you can respond more to sectoral inflation because it protects the employment of the poor and kill this second round effect. Philip, this is an excellent point. In the other paper, now I don't want to overcomplicate things, we go and look into fiscal policy. Also fiscal policy have in the US paper, and we show in that paper that fiscal policy can also short-circuit this discretionary cycle. It's a little bit more complicated, but there goes into the government announcing a VAT increase on discretionary spending in the future. These bring forward discretionary spending and therefore boost the employment of the poor, therefore counteract the recessionary effect. So you're right, also fiscal policy could achieve that superior outcome for society, even without having an explicit redistribute motive. And I think this is very important, and we kept as two separate tools.
I just want to reiterate what I saw during my discussion, that when you describe it, it sounds very much like that should be the job of somebody else and not the monetary policy to smooth basically the employment of the hand-to-mouth workers. But I think it will be just nice to have a competing policy or a competing model that shows which one is more welfare enhancing.
But please, let me clarify once more. I'm saying the central bank should do that not because it's interested to protect the employment of hand-to-mouth of the poor people per se, but because by protecting that, help with inflation, aggregate inflation, and aggregate output outcome. So it's not the job of the central bank to care about the redistribution. I think that's the job of the government. But the redistribution has massive impact on aggregate inflation and aggregate output. And this is the only extent to which the central bank should intervene, and focusing more on discretionary inflation. You protect the poor, but not because you care necessarily about that per se, but because achieve superior aggregate outcome for inflation and output. This is, I think, very important to emphasize.
All right, we have less than 5 minutes. I have more than 5 people who asked for the floor. That is a challenge. I will therefore close the list of speakers. I have the lady right there, who was actually the first of the 5. And then I will go to Oscar Arce. And then I might move back to this side of the room. Please.
Beata Jaworczyk, EBRD and Oxford. How does international trade come into play here? Presumably, a large share of discretionary spending comes from imports. Think about electronics, white goods, gardening equipment imported from China. If the efforts of advanced economies to reshore, to bring back production are successful, does it mean that tilting the structure of the economy towards discretionary sectors will lead to amplification of business cycles through the mechanism you described?
Thank you very much. Oscar.
Thank you, Paolo, for a very nice paper. So I was trying to make sense of your key recommendations out of the practical experience at the ECB technical work over the last few years. So you are calling us for focusing more on discretionary inflation, less on necessity inflation. But necessity inflation is probably overpopulated by energy and food items, as Isabel mentioned before, which are likely to be driven especially by supply factors more than discretionary inflation. So at the end, my way of understanding your key recommendation, tell me, I would like to know your reaction. You are telling us, in a sense, at the end of the day, okay, you should react probably less to supply-driven inflation and more to demand-driven inflation. Well, probably this is what central banks have been doing most of the time, no? Except in some cases of large supply-side shocks that, as Isabel mentioned, okay, may deserve a strong reaction, no? But can we say that probably we are doing something along coherent with your recommendation, following a different route in the sense that we look at the nature of the shock rather than changing the notion of core inflation. Is it a correct interpretation? And secondly, also about interpretation. I mean, at the ECB, we have paid a lot of attention in the last few years in our inflation analysis to a battery of underlying inflation indicators, out of which what we call the persistent common component of inflation, the so-called PCCI, has received some special attention, precisely because we think it's a good indicator of persistency of inflation. So in principle, this would be very much in line with your recommendation. No? Focus on those components of core inflation that are probably more informationally rich about the persistence of the inflation shock. Would this be a correct interpretation? Thank you.
Thank you, Oscar. I have made some incredibly tough decisions now. So there are two more speakers. Governor, wait up, please. And then I will give you the floor up here. You ask for the floor, you'll get the floor, but be short.
So continuing with the previous question, we central banks usually say we look through supply shocks. But when they come to, when they feed into underlying inflation, we have to worry. Does your model, even though it doesn't have sectoral supply-demand shocks, say anything about when this is likely to happen?
Pierre?
Thank you. Thank you for this very interesting paper. I was trying to reconcile your story with the number we have seen in the last cycle. We were all surprised by the resilience of the services sector, which, from your example, mostly overlaps with this discretionary consumption. And we didn't see much of it. We were all surprised by the resilience. So how does this fits in your story? And maybe you are missing one additional dimension of heterogeneity, which is the composition of disposable income across the income distribution. Maybe this is an important contribution that would allow you to explain why, despite the fact that, according to your story, services should have not performed so well as they did, perhaps has to do with the composition of income distribution, of the disposable income across the income distribution.
Thank you, Piero. Paolo, and then we close.
So, all very interesting. Let me clarify something. One of the main takeaways from the paper is that this is so much different from services, durable and non-durable categorization. So I think it's very misleading to look at those results and try to make it squaring to how they reconcile. In the paper, we do that. In fact, again, if I can ask the big brother to put up another table from the presentation, I think this could give the number for that. To go back to your point, no, so you're right that the vast majority of durable goods are discretionary. But there is a 50% of after discretionary goods that actually are services. So there is a component of tradability, but it's not significantly larger for discretionary than for necessity, because the majority of discretionary does not come from durable. If we can put my, presentation back. Oscar, again, also this one. To a first approximation, we discussed this before. This is a list of how necessity and discretionary can be non-durable necessity, non-durable discretion, and also between services. So those are a list of examples. And here is a list of the table. So this is the point I wanted to make. Services are equally split between the two. In fact, services and non-durable are an even larger share of discretionary than those are durable themselves. So there is some nuisance to be added, but yes, to a first approximation, food and energy account for 40% of the necessity, but there is more. Move less, but there is more, and here there is a list of what there is more there. Who am I to tell the European Central Bank what to do? But if you tell me that you are already doing, I take a great pride, because now perhaps there is a theoretical foundation that goes into this divide for what you're doing. And if the message that you take away is now we have discovered that the persistence comes from discretionary inflation and that the high-frequency movement comes from necessity, I think this is the right message to take. I'm not a big fan, I discussed this last year here in Sintra, of the supply-demand dichotomy, because I really don't think it's useful. I focus on a general recession, I focus on a monetary policy shock, but when there is a recession, hand-to-mouth are the first to lose the job, especially in the discretionary sector. I don't want to say almost independently of the source of the shock. It's not really like that, but I think it's more than supply and demand, and I'm just emphasizing that the necessities discretionary divide is a different way of thinking about persistence of inflation, business cycle, unemployment, and all the other effects. And then the third question I forgot. Sorry, I even took note. Was, okay, also this one. There are discretionary and service. So there is also plenty of necessity sector, necessity services, and discretionary services. The composition of disposable income is very, very important. And you're right, we don't impose that heterogeneity in the response of disposable income. We get at an outcome, both in our model, in our data. Poor households are the ones that they drop their disposable income more, and their disposable income is more tilted in the data and in the model toward necessity. So a cut in discretionary spill over to necessity and bring the whole economy down. That's why fiscal and monetary policy can have a big role in short-circuit that.
Paolo, thank you so much. I see that Claire is waiting to step up. My summary will be as brief as the Vice President who showed the way. So the only thing I want to say is that we will now all go to the gym. We will order tickets for the opera. Then we will take our new electrical car and drive to beautiful, albeit warm, Puglia. And now, joking apart, while we do that, we will think about not just the inflation of the poor, but also the employment of the poor. And with that, Maria Teresa and Paolo, thank you so much.
Thank you.
I think we can
So that includes the 2 opening sessions to this year's Sintra. Thank you to the chairs for doing so well, to the panelists for giving us plenty of food for thought, and to all you guys who asked a question and made a comment, to some nice spicy reactions there, so please keep them coming. We're now going to break for coffee and give you a chance to look at the Young Economist posters in the foyer, and we'll meet back here at 11:10. Thanks a lot.
Using Euro area survey data and a macroeconomic model, I showed that adjustable mortgages amplify policy transmission only when they're held by households that have a high marginal propensity to consume.
I specialize in behavioral macroeconomics, and in recent work I asked, does it matter who communicates policies to the public?
And my work explores the international spillovers of monetary policy, focusing on the role of currency compositions in portfolios in shaping the global transmission of monetary policy.
In particular, I use advanced text analysis tools to study how the inflation expectations of households and experts are related to causal media narratives about the triggers of inflation.
In a recent paper, I explore why women have higher inflation expectations than men.
In this work, we explore the consequences of supply chain disruptions on the German manufacturing sector using a novel identification strategy based on survey data.
I find that targeting these more productive urban areas leads to the largest welfare and production gains at the country level.
We use the US experience to draw new lessons that can inform the current debates on the merits and the importance of completing the EU banking and capital market union.
And I'm working at the intersection of macroeconomics, climate change and international trade, with a particular focus on optimal economic policies and inequality across countries.
Combine economic theory and empirical data work and find that increasing subsidies can in fact be cost effective due to two indirect effects.
Ladies and gentlemen, it is now my pleasure to turn over to the 10 finalists of the 2025 Young Economist Prize. Each of our finalists is going to give you a brief speed presentation of their findings. Over to you guys.
The planet is warming. We are emitting more and more carbon in the atmosphere, and nobody is doing anything about it, or at least not enough. The economists argue that the optimal solution is to put a Pigouvian tax on fossil fuel. If we make the oil, gas, and coal more expensive, consumers will reduce their emissions and firms will switch to solar and green. Seems pretty simple, but few governments want to do this. Why? Because carbon taxation is costly, and most of the benefit will be borne by other countries. That's the free riding problem of climate policy. But what can we do about it? How can we solve this free riding problem and fight climate inaction? How can we make our planet great again? One solution to promote global cooperation is the idea of the climate club, a climate agreement where members set a carbon tax on their own emissions and set trade tariff against non-members. In my research, I study how to optimally design these climate agreements, and I built a rich quantitative model with a climate system, inequality across countries, international trade, and the country's strategic decision to participate in the agreement. The optimal agreement that I find gathers all the countries in the world at the exception of major fossil fuel producing countries like Iran or Russia. The optimal carbon tax is lower than the Pigouvian framework by 25% and also impose large trade tariff against non-members. Lowering the ambitions and imposing large trade retaliation is very important to incentivize some countries that would deviate, for example, India or the US. So it allows to reduce emission by 30% and maximize welfare, which would be a first step to fight climate change. Thank you very much.
Good morning. My name is Leonardo D'Amico, and I'm graduating from Harvard University, and I will join the faculty at the University of Chicago Booth School of Business. Europe needs to meet large investment challenges, and my research speaks to this topic by considering the process of financial integration of banking markets, by which I mean the process through which the financial sector manages to allow liquidity raised in one location to easily finance loans and opportunities potentially far away. I studied this topic in the context of the US banking sector in the mid-1900s, with the explicit motivation of drawing some new lessons from the American experience about the merits of completing the capital market and banking union in the EU today. To draw these new lessons, my research brings new data from that historical period and a new theory that allows me to study jointly the mobility of financial capital across regions, jointly with the mobility of other real resources, such as labor and goods. So what do we learn from this period? There's two new lessons, both of which suggest that completing the capital market union in the Eurozone today might be much more important than previously thought. The first reason is that Europe comes out of a protracted low-rate environment. The American experience actually shows that low interest rates can breed substantial financial segmentation. The intuition is quite simple. When interest rates are low, households are more likely to hold their liquidity in deposits at their local bank instead of investing in national money markets fund and securities market, which are better suited to redistribute this liquidity across space. Hence, when we come out of a protracted low-rate environment, allowing banks to act as a single entity across space and move liquidity across space is much more important because there's just so much more of that liquidity to be redistributed. The second lesson actually relates to the debate, to what we learned this morning from Benjamin and Nicole, and the debate that we had after, which is the relationship between capital market union and labor markets. In particular, I think a way to reconcile both of the topics that have been raised is actually that what my research shows is that when labor markets are frictional, actually completing integration of capital markets is even more effective. The reason is that, for instance, in the EU, households and workers do not move much across EU countries, as opposed, for instance, to workers in the US. And so when workers do not move much across space, actually allowing capital to do some of that movement can be much more effective. In other words, enhanced capital mobility actually can substitute and enhance economic efficiency, especially when labor is not that mobile across space. So thank you so much.
Hi everyone, I'm Friederike and I'm currently pursuing a PhD at the IFO Institute and the University of Munich. And in our paper, we analyzed the effect of input material shocks or eventually supply chain constraints on the German manufacturing sector. And our paper makes two main contributions. First, methodologically, we suggest a novel bottom-up identification approach where we used microdata to identify a macro shock and by exploiting time series patterns of firms' forecast errors. Second, in our empirical application, we then construct two time series for easing and tightening input material shocks, and we show that their effects on production and prices are asymmetric. A tightening shock leads to an immediate and persistent increase in prices, whereas the effect on production is smaller and in particular temporary. An easing shock, in turn, boosts production, again only temporarily, but now prices take much longer to decline. And in particular, we also highlight that the magnitude of the effect of an easing shock is much smaller than a similarly sized tightening shock. In our paper, we also argue that our findings may be relevant and interesting from a monetary policy perspective and also from a financial stability perspective. On top of that, we believe that given appropriate granular microdata, our identification strategy may also be applied in other settings too. And in particular, the resulting shock series may then provide value in informing in a timely fashion about potential vulnerabilities at the firm level that may also spread over to the broader economy. Thank you.
Good morning, I'm Marco Irisarri, and I'm a PhD candidate at Universitat Pompeu Fabra in Barcelona. My job market paper starts with a question. Are entrepreneurs and their capital allocated optimally across space? And should governments employ place-based entrepreneurial policies? These questions are important to understand capital misallocation and the design of entrepreneurial policy, but they remain underexplored. To fill this gap, I developed a rich dynamic spatial model featuring occupational and location choices, financial frictions, agglomeration forces, and endogenous capital accumulation, and then take the model to the largest 20 urban areas of the Spanish economy by making use of rich administrative social security data as well as balance sheet data on firms. In doing so, I obtained 3 key findings that are policy relevant. The first one is that the model predicts and the data supports that more productive urban areas are more capital constrained. Second, in line with this intuition, I find that targeting these more productive urban areas leads to the largest welfare and production gains at the country level. However, this comes at the cost of exacerbating regional economic disparities, which poses a challenging trade-off to policymakers. And third, I find that the design of the policy matters. Lump sum transfers, where the average euro is spent on smaller, younger, more constrained entrepreneurs, leads to larger welfare and production gains than size-dependent policies, such as guarantees or loans, which are actually more common in practice. And so, my research stresses the importance of accounting for space in understanding capital misallocation and the design of entrepreneurial policy. Thank you.
Thanks so much for having me. I'm Patricia Masner from Stockholm University. So one big challenge of the 21st century is how we can organize care for the increasing number of seniors worldwide. Professional care, think for example nursing homes, but also home care, is expensive to seniors, so many seniors rely on their family members to receive care. A potential alternative to this family-provided care is that we make professional care more accessible to seniors through government subsidies. I argue that while such government subsidies ensure the seniors against these large financial risks of becoming dependent in old age, they also must be financed. Therefore, understanding how government subsidies impact not only the seniors, but also their caregivers and ultimately government's budget is important for the design of elder care systems. So in my research, we address these questions and study the economic and health impact of a reform in Sweden that subsidized elder care services in 2/3 of Sweden's municipalities. We do so by combining quasi-random variation with a theoretical model, and we have 3 main findings. First, when we look at the seniors, we find that subsidizing elder care leads also to an increase in the demand for elder care services. Importantly, at the same time, these seniors are less hospitalized, especially they go less to the hospital for conditions that are preventable or treatable outside the hospital setting. Second, when we then look at their adult children, we find that they are increasing their labor supply in response to these subsidies. And what's interesting here is that rather than temporarily adjusting the labor supply depending on how much care the parents need, they are persistently shifted into new higher paying career paths. And then finally, third, when we take these indirect effects into account, so that is how the seniors change their healthcare utilizations, as well as these intergenerational effects on the children, these subsidies can actually pay for themselves and are welfare improving. Thanks so much.
Hi everyone, my name is Lovisa. I'm currently a PhD student at the University of Oxford and incoming AP in Finance at the Norwegian Business School. In the paper here, I'm looking at the gender gap in inflation expectations. And by that, I mean the finding that consistently women report higher inflation expectations than men. This is about 2 percentage points, so it's quite sizable if you think about your average inflation targets. Now in the paper, I look at the drivers of this, and in the past, this has sort of been attributed to women in traditional gender roles, maybe seeing more food prices than men. Now I show that this is not the full story, and this is actually missing one really crucial finding, which is that confidence also matters a lot for forecasting. And we know that women have lower financial literacy and lower forecasting sort of confidence. Now, I show this using the data from Germany and the US, where I show that closing the confidence gap would actually close the gender gap. But more importantly, those that have low confidence, they rely a lot on the prices of groceries, whereas those with high confidence, they do not. Now, I showed this also in a Bayesian updating framework, where if you think you have a flat prior, then signals matter a lot more than if your prior would be very precise. I think that this is a finding that is very important beyond gender, because it shows that anything that sort of reduces your confidence, and this may be age, this may be income, this may also be the geopolitical climate actually, brings you to rely more on the price of like simple local signals, such as maybe the price of butter. And this actually helps us also to explain sort of broader patterns and heterogeneity beyond the gender gap, and helps us to sort of stabilize inflation if we target confidence more through improving financial literacy of everyone. Thank you very much. And,
Good morning. My name is Giovanni Sciagovelli. I am from Italy, and I just finished my PhD in economics at Northwestern University. There is a problem in the euro area, which is that the transmission of monetary policy is very heterogeneous across countries. Now, this represents a problem because it implies that when the European Central Bank implements its policy actions, they will have very different effects on the different countries that are part of the Union. As a consequence to this, it is crucial to understand the underlying reasons that explain this heterogeneity in transmission. And this is precisely what I do in this project by focusing on one channel of monetary policy transmission, which is the mortgage channel. There are two questions in particular that I'm after. First, I want to understand precisely how monetary policy is transmitted through adjustable mortgages in the euro area. Second, I want to quantify the extent to which differences in transmission across euro countries can be attributed to differences in transmission through adjustable mortgages. In order to address these questions, in the first part of the project, I implement an empirical analysis where I show that in the euro area, the strength of transmission is particularly high in countries that have both a high share of adjustable mortgages and a high fraction of households that are liquidity constrained. Based on this finding, in the second part of the project, I build a quantitative model with heterogeneous agents. The model shows that in order for adjustable mortgages to be a powerful vehicle of monetary policy transmission, they need to be matched with high marginal propensities to consume, since marginal propensities to consume control the sensitivity of consumption to changes in mortgage payments. In addition, I also use the model to show that approximately 40% of the empirical differences in transmission across euro countries can be attributed to differences in transmission through adjustable mortgages. Overall, there are two key takeaways from this project. First, adjustable mortgages and marginal propensities to consume interact in powerful ways for monetary policy transmission. Second, differences in transmission through adjustable rate mortgages are important in order to understand the overall differences in transmission across euro countries. Thank you.
Hello, everyone. I'm Jacob, and I'm a PhD student at the University of Copenhagen. My paper tackles a classic question, which is what happens to the rest of the world when the US tightens monetary policy? The traditional answer to this question is that when the US sneezes, the rest of the world catches a cold, meaning that the rest of the world goes into a recession. I confirmed this in the data, but only when looking before 1990. Instead, today, it's no longer the case that a tightening of US monetary policy creates recessions abroad. So the question is then, what is driving this change in spillovers? And here I point to a structural shift in the US economy over the same time period, which is that the US has gone from a net creditor to a net debtor. This means, on the flip side, that foreigners now hold significant dollar wealth. And how may this change the transmission of spillovers? Well, consider the following channel. When the US tightens monetary policy, the dollar will tend to appreciate. This means that the foreigners' holdings of dollar wealth is worth more, which creates a positive wealth effect on consumption. I test this channel empirically using a panel dataset of 37 small open economies. Here, I find that countries that hold more dollar wealth are indeed more insulated from the tightening of US monetary policy. I then built a 3-region New Keynesian model with partly dollarized balance sheets. And in this model, I find that the dollar wealth effect on consumption is driving most of the change in spillovers. In this sense, my paper challenges the conventional view that when the US sneezes, the rest of the world catches a cold. And in some sense, it's really a success story about countries avoiding foreign currency debt on their balance sheets. Thank you.
Hello, everyone. My name is Giovanni Trebbi, and I'm graduating from Tilburg University. My work studies whether the inflation expectation gap between households and experts can be explained by narrative disagreement between newspapers over whether inflation has a demand or supply origin. And I can answer this question thanks to a novel text analysis tool called causality extraction that allows me to extract causal relations from text and determine whether a newspaper attributes inflation to a demand or supply origin. Now, we all know that over the past 30 years, in the US, as well as in many other countries, the inflation expectation gap has been positive and volatile. And in particular, it has been positively related to press coverage about inflation, in contrast with what we would expect based on standard attention models. Now, I argue that this might result from households reading general newspapers that report the views of experts less accurately than more specialized newspapers. So the disagreement might be key here. And in particular, what might be important is the disagreement about the triggers of inflation. As recent survey evidence suggests that households and experts disagree in their views of where inflation comes from. Now, we don't have their time series narrative data, but we can proxy their narratives with the narratives of general and specialized newspapers. And essentially what I show is that when narrative disagreement between general and specialized newspapers increases, the inflation expectation gap widens, particularly for non-college educated households that are farther away from experts, and for older households that are more likely to read newspapers. So the policy lesson here, I think, is that for policymakers to convey their narratives, they need to consider a wide array of channels, as the main channels might not reach households. Thank you very much.
Good morning, everyone. I have the pleasure of wrapping up the Young Economists. My name is Alena Babic. I just finished my PhD at Oxford, where I specialize in behavioral macroeconomics, and I've also worked on how AI impacts the labor market. I specialize mostly on inflation expectations, how they link to real decisions, and also complexity and central bank communication. In a recent project, I asked, does the messenger of policy communication matter? And I find yes. The messenger can actually positively impact both the reach and impact of policy communication. This happens when the public shares characteristics with the messenger. I explore the role of the messenger in 3 parts. First, I create real-world evidence from Twitter, where I show that when the ECB president shares nationality with the public, there is more information available on ECB press conferences, but also beliefs update more strongly towards the signal of the press conference. In a second step, I design an inflation forecasting experiment, and I show that causally, the messenger impacts inflation expectations in 4 different euro area countries. So they update inflation expectations more strongly to a signal of a messenger of shared nationality. In a third step, I design or develop a stylized coordination model on the social value of public information. I do this to answer a normative question. How should we optimally communicate to the public in light of the messenger effects that I find empirically? And the answer is, what maximizes social welfare is to be strategic with the messenger. Sometimes we should diversify who communicates, other times we should centralize communication. And it depends on the quality of public information. So this makes the messenger itself a policy tool that's available to central banks, but also to governments to communicate their policies on monetary issues, but also fiscal, health, or climate issues. Thank you very much.
Thank you very much to all 10 of you for those very, very impressive summaries. And I think we wish you all the best of luck. To those of you here in the audience, you have until 9 a.m. tomorrow morning to vote on your favorite, and we'll then announce the winner tomorrow afternoon. The euro area continues to be made up of diverse economies, each with their own strengths and weaknesses. While there has been a high degree of convergence of late, there's still the sense in which, when it comes to monetary policy, one size may not fit all. This year's opening panel will explore how such differences affect the effectiveness of what the ECB does. It's an honour to say it will be chaired by Executive Board member Isabel Schnabel. Dr. Schnabel, the floor is yours.
So thank you so much, Claire, for your introduction, and good morning to everybody. It's a really great pleasure to welcome you to our panel on cross-country heterogeneity in the euro area and implications for monetary policy. And we are fortunate to have with us a distinguished panel which brings diverse and complementary perspectives to this important topic. So thanks to the four of you for being with us. As you all know, the euro area is unique in its design. A monetary union with a single monetary policy, but with distinct economic and financial structures and different fiscal and economic policies. And this reflects the diversity of Europe's economies and societies. However, it also presents challenges for the euro area's common monetary policy. In understanding how cross-country heterogeneity affects the transmission of monetary policy across member states has been a key question since the creation of the euro. Take the example of the inflation dynamics following the pandemic and Russia's invasion of Ukraine. At that time, we saw not only elevated inflation for the euro area as a whole, but also record high differences in inflation rates across euro area countries. In August 2022, the inflation gap between the country with the highest inflation, which was Estonia at 25.2%, and the country with the lowest one, France, at 6.6%, was 18.6 percentage points, so quite significant. And while these inflation differentials have since narrowed and are now below their historical average, pointing to an effective monetary transmission, they do serve as a stark reminder of the complexities in the conduct of monetary policy in the euro area. And these emerge from both the real and the financial sides of the economy. They can stem from country-specific institutional features like national conventions for wage setting or prevailing lending practices, or from household and firm characteristics such as differences in their financing structures or an uneven exposure to shocks. And they may also derive from different policy responses to shocks, as we have seen in 2022 when energy prices surged. All these dimensions may influence monetary policy transmission. Furthermore, significant differences in the fiscal space across euro area countries may impinge on their ability to address the massive investment needs associated with the digital revolution, the green transformation, and the strengthening of our military defense. And such heterogeneities can translate into persistent differences in economic growth. Initiatives and reforms to foster greater integration across key domains are essential to address structural disparities. Recent international developments not only underscore the urgency of deeper integration, but they also present a unique opportunity to advance it. And given the utmost importance of this topic, we are very lucky to have four distinguished experts on our panel. So I will give the floor to the four of you. I would ask you to stick to the 10 minutes so that we will have time to have an interesting discussion afterwards. And my first speaker is going to be Agnès Benassi-Kéré, who is Deputy Governor of the Banque de France. No one would be better suited to kick off this session than Agnès, who's playing an outstanding academic career with rich policy experience. We interacted already a long time ago when we were both members of our respective expert councils in France and Germany, and when we were together in the Franco-German Council of Economic Experts. And one important output of our collaboration was the 7+7 report on euro area reform, which still carries relevance today. So in her remarks, and yes, we focus on how cross-country heterogeneities impact monetary policy transmission. So please, and yes, the floor is yours.
Thank you very much, Isabel, for your kind words. Thanks for the invitation. I'm very happy and honored to be here with you. So let me focus on two sources of heterogeneity of monetary policy transmission across member states. The first one is the pass-through of policy rates to lending rates, and the second one is nominal rigidities. So first, lending rates. Here, on the right-hand side, you have the evolution of interest rates on new bank loans to non-financial corporations over the last monetary policy cycle in the different euro area countries. So what you see is that the level of interest rates varies, and Isabel, you mentioned inflation differentials across countries. So you have differences in the levels. However, they all follow the same hump shape. And when you look, despite the fact that the share of short-term versus long-term lending is different across the different countries. So when you look just at this figure, you don't have the impression of heterogeneous monetary policy transmission across euro area member states. Now, when you move to the left-hand side, this is the same, but for household, for credit, for housing. It's a little bit of the same with the hump shape. However, you see more heterogeneity with some countries displaying smoother evolution of interest rates. And this corresponds to the literature that has highlighted one source of heterogeneity across member states, which is the mortgage market. And we had a presentation a minute ago by one of the poster author on this topic. So now let me move to the interest payments. So these are the interest not on the new loans, but on outstanding, on the legacy debt of the non-financial corporations. And here I'm focusing on firms. Of course, interest payments are the combination of leverage and the effective cost of debt. So on the left-hand side, you have the leverage in percent of GDP in the different members of the euro area in 21, just before the start of the rate hikes. Be careful because these figures are consolidated for at the country level, but not for cross-border lending and debt. Hence, for some countries on the left-hand side, it's a bit distorted. But even if you leave them out, you still have a huge heterogeneity. Leverage moves from, say, 30% of GDP to 100% of GDP. Now, you combine with the right-hand side, which gives the combination of maturity of the debt, average maturity of the debt, and the share of short-term, fixed rate debt. And here you see that for most countries of the euro area, you expect relatively fast pass-through of monetary policy onto interest payments because these are countries with a combination of either short-term maturities or a high share of flexible rates. However, on the northeast of the graph, you have 4 countries with a combination of relatively long maturities and high share of fixed rates. So here you expect the monetary policy transmission to be much slower. Interestingly, for 3 of these countries are countries also with high leverage. So in a sense, this compensates each other. Now, these effects are really sizable. Here, I focus on 3 countries, Spain, France, and Italy. And this is microdata. We calculate the average effective cost of NFC's debt over time. And the difference between, say, Italy and France is really sizable, between 22 and 23, which is the last year we have at this stage. You have a jump in the cost of effective cost of debt in Italy by about 250 basis points against less than 100%. 100 basis points in France, and Spain is in between. On the right-hand side, you have the same for the median, and it's the same picture. So these results are not driven by a few large firms. Now, let me move to the second source of rigidity, which is nominal rigidity. Here you have a table showing the rigidity of nominal wage setting. So when you move from the top of the table to the bottom of the table, you have more nominal wage rigidity. And if I concentrate on the top and the bottom, on the top you have Belgium, where there is a yearly indexation, although there is also a norm on the real wage. This translates on the right-hand side in accumulated real wage growth in Belgium, which has hardly been negative during the inflation cycle. And you see it's even above the starting point after a while. The opposite is Italy, with negotiations that take place more or less every 3 years. So there's a lot of nominal rigidity, and you have a drop in the real wage in the short term, and a slow recovery from this level. So you expect from this graph because the textbook will tell you more nominal rigidity means differences in monetary policy transmission, and this is what you expect. So does it matter, in fact, when you move to the macroeconomy, especially to the transmission to inflation? And here I'm going to show some reassuring results from local projections for the euro area and for 11 euro area countries. So the methodology is the same as what Paolo showed in the previous session. So here I save time. And I look at the impact of monetary policy surprises on GDP and inflation for the euro area as a whole, and for the panel, and for a country-by-country basis with some controls. And the shock has been rescaled, but it's very much the same as Paolo has shown. So here you see something that is very standard, that the monetary policy tightening of 25 basis points will make real GDP and inflation drop. The blue line is for the euro area as a whole, and the red line is for the panel estimation. And what is interesting is to see that the two curves are close to each other. And secondly, the confidence band for the panel is relatively small. This suggests that there is not so much heterogeneity across the members of the panel. Now, if I zoom on each country, so here you have the results on the country-by-country basis after 12 months. So this is the same shock, but after 12 months. For the euro area, you have the red dot is the panel result, the green dot is the panel, the red is the aggregate result, and the blue dots are for the different countries. And what is really striking is that, say, look at the right of the graph, you have Italy, the Netherlands, and Portugal that are on the same line as the euro area as a whole, also Germany, just on the left. And so there doesn't seem to be too much heterogeneity in terms of monetary policy transmission to inflation. There is more heterogeneity on the left-hand side for real GDP. Now, the literature has suggested that the maturity of the loans would matter. So what we have done is to interact the monetary policy shock with a dummy for the share of either long-term loans to the non-financial corporations, whether it's high or it's low. And the blue line is for for low share of long-term loans, and you see that the monetary policy transmission seems to be more forceful in those countries with less long-term loans to non-financial corporations, and the difference between the two is significant after 6 months, as shown in the table on the right. Now, let me move to the conclusion. There are significant structural heterogeneities across euro area countries, no doubt about that. The heterogeneities in monetary policy transmission, there are some, but it's difficult to connect them to the structural heterogeneities. And on the whole, in terms of transmission to inflation, it doesn't seem to be so much marked across the member states. Possibly debt maturity could have an impact. And it doesn't mean that when you look at the details, for instance, consumption, the mortgage market, you do have differences, but it could be that there are so many heterogeneities that maybe they cancel each other at some point, and depending on what you look at, you have a different, and I think this is also the lesson from the literature. Now, coming to the presentation by Paolo this morning, I think that the heterogeneities within euro area countries may have more implications, actually, for monetary policy at aggregate level, at the euro area level. Let me mention just one, services versus goods. We know that the price setting in services and in goods are extremely different. And if you take only services and you look at cross-country heterogeneities, they are not much. So the heterogeneities between sectors is much more than heterogeneities within one sector across countries. So maybe for monetary policy at the euro area level, the message is that to read the paper of Paolo this morning in detail and other papers on this topic, because maybe this is more important for the conduct of monetary policy. Thank you very much.
So thank you very much, Agnès, for a very interesting and clear presentation and an interesting message. So now we're going to move on to our second panelist, Luca Fornaro, who is a senior researcher at CREI and professor at Pompeu Fabra and at Barcelona GSE. He has written, among many other things, a very important paper on stagnation traps, partly while he was part of our L'Enfant Laissé fellowship program. And he's a recipient of both an ERC starting and consolidator grant on the topic of productivity growth. Today, Luca will shed light on how heterogeneous public debt levels may lead into a situation that a single monetary policy cannot deal with easily, and I hope you're going to tell us what can be done about it. So the floor is yours, Luca.
Okay, so thank you very much for inviting me to participate in this panel. It's a great pleasure to be here. So as we all know, in the euro area right now, we have a lot of heterogeneity in public debt position, right? We have some countries who have a very high level of public debt to GDP, while some others have moderate ones. And in these remarks, I want to think about the implications of this heterogeneity for the euro area. And in particular, I want to focus on the relationship between public debt, investment, and productivity growth as a possible source of divergence among member countries. Let me start by showing you very quickly a bit of data. So here I'm plotting the evolution of public debt to GDP and labor productivity over the last 30 years for a sample of 16 advanced economies. And I split the sample between high debt countries, the blue line, and the rest, the red line. And the simple point that this graph makes is really that high debt countries tended to have lower productivity growth over the last 30 years, which is not surprising, right? Because if you think about it, you would expect to have a two-way relationship between productivity growth and public debt. So on the one hand, you would expect that a period of low growth will tend to push up the public debt to GDP ratio. And that's mechanical, right? Because when you have a slowdown in growth, your future GDP tends to be lower. And so the ratio of debt to GDP will tend to go up. It's just a debt accumulation equation. And that's what the red line in this diagram is capturing, the idea that a lower growth rate will tend to cause an increase in the debt to GDP ratio. But especially for high debt countries, some reverse causality might be at play. So you can think that when you have a high stock of public debt, in order to sustain it, the government will have to implement fiscal measures that will generate distortion and that will trigger a slowdown in investment and so a slowdown in growth. So think about, for instance, imposing high taxes on capital and labor, or cutting spending on public services and investment, or even just the fact that when you have a high stock of debt, the government might have little space to run a counter-cyclical fiscal policy. So all these factors will tend to imply that a high debt to GDP might translate into weak investment and low productivity growth, which is what the blue line on this diagram is showing. So what if I put these two forces together? I get an amplification effect. I get a vicious cycle between public debt and productivity growth. And the idea is very simple. Imagine that a country is hit by a bad shock, a shock that requires a fiscal adjustment. So if this fiscal adjustment triggers distortions in the economy, it will result into lower investment and lower growth. And lower growth will tend to push up the debt to GDP ratio. So to make this debt sustainable, the government will have to come up with an even larger fiscal adjustment. And this will trigger another round of lower investment and growth. You see, there is really an amplification, a vicious cycle between the fiscal side of the economy and the productivity side of the economy. And we have studied recently, in joint work with Martin Wolf, this amplification effect, this vicious cycle. And what we argue is that these kind of forces can lead to multiple long-run equilibria. So there might be a desirable, fiscally sound equilibrium in which low public debt and high growth tend to support each other. But those countries which have a high stock of legacy debt, which inherited a high stock of public debt from the past, might instead converge to a different equilibrium, to a fiscal stagnation equilibrium in which high public debt, fiscal distortion, low investment, and low growth, they tend to self-perpetuate each other, right? They tend to maintain each other over time. So is this relevant for the euro area right now? I think so. Because right now, in the euro area, we are envisioning large public investment in order to foster the green transition, the digitalization of our economy, so the adoption of AI technologies and defense. And there are reasons to think that this kind of investment might boost productivity growth. They might revive productivity growth in the euro area. So we have some recent estimates, for instance, from the literature, which suggest that investment in public R&D might have very large rate of return and very large impact on productivity and GDP. However, the fact that part of the union might suffer from public debt overhang might hinder investment in part of the union. So we might end up in a two-speed monetary union, a union split between a fiscally sound high-growth bloc and a fiscally stagnant one. So you might ask, is this a problem? In the end, even if you look at the US, high productivity activities tend to be geographically concentrated. Think about the Silicon Valley. However, in the euro area, we don't have some of the mechanisms that allow the economy to share widely the gains of high productivity clusters. We don't have a fiscal union. We don't have we have an imperfect capital market integration. So this is going to make it harder for Europe to share the gains of geographically concentrated high productivity regions. Moreover, for monetary policy, it might be hard to deal with a union split between a fiscally sound and a fiscally stagnant bloc. Why? Because the fiscally stagnant bloc is going to feature low productivity, and low productivity growth tend to be associated with depressed demand, and so depressed economic activity, but inflationary pressures because low productivity sustains firm marginal cost and so inflation. So I would say that ending up in a two-speed monetary union is a very bad outcome that we should avoid. Can we avoid it? Can we design policies that mitigate the risk of fiscal stagnation in part of the union? The good news is that I think so. I think that we can change our fiscal policies toward more pro-growth interventions that tend to lift productivity growth and future GDP. Here I'm showing you some empirical evidence from a very nice recent paper by Antonin Diaz and Surico, where they look for the US at the impact on long-run output and long-run productivity of different type of government expenditure, different type of fiscal measures. And what they find is very interesting and encouraging. They find that increases in public investment, especially public investment in R&D, tend to lift productivity and GDP in the long run. So there is scope for tweaking our fiscal policy in order to increase GDP persistently. And that's good news, because this kind of fiscal intervention, pro-growth fiscal intervention, might not only jumpstart productivity, but they might also help us to reduce the public debt to GDP ratio by increasing GDP. So they can trigger a virtuous cycle of higher productivity and public debt reductions. So what can you do in order to foster this kind of pro-growth policy? At the national level, interventions such as the preferential treatment that public investment has received in the new Stability and Growth Pact is a very good idea because it encourages government to maintain public investment high. Another policy that we might think of are automatic investment stabilizers. So during deep crisis, government tend to cut public investment, or they tend to undertake measures that compromise private investment. Having some automatic investment stabilizers in place is one way to avoid this outcome. And given the high heterogeneity in public debt that we have right now in the euro area, I think that a good idea is also to think about joint financing of some public goods, especially public R&D programs, because the evidence that we have suggests that public R&D programs, of course, well-designed, well-crafted, might have a very big impact on productivity. All right, so can monetary policy do something? Of course, the main mandate of monetary policy of central bank is not to foster productivity growth. But I think that monetary policy can do something to complement supply-side policy, pro-growth fiscal policy, in order to stimulate productivity. The first point here is obvious. So maintaining anchored inflation expectation is important, because when inflation expectations are anchored, medium-run interest rates tend to be moderate, and this is going to make it easier to foster fiscal adjustment, but also to trigger private investment and growth. Having a strongly counter-cyclical monetary policy is also important, because we have evidence that deep recession tend to leave persistent scars, persistent negative effect on future productivity. So having a strongly counter-cyclical monetary policy is one way to avoid these scars, to avoid recession from having a persistent impact on productivity. And the final point is about maintaining robust aggregate demand. So conditional on anchoring inflation expectation, I think that it's important that monetary policy creates a high demand environment. Why? Because in the end, firms invest in order to increase their productivity to capture profits. So when are the incentives to do so, to increase productivity for firms high? When there is high demand for their product. So I think that maintaining a high demand environment is also important if you want monetary policy to help boost productivity growth. Okay, thanks very much.
Thank you, Luca, for a very insightful presentation. So we move to our third speaker, who is Pete Christiansen, who is the Chief Market Strategist at Danske Bank. So Pete is one of our key ECB watchers and a true expert of European fixed income markets and monetary policy. And this must be because he worked 2 years as an ECB research analyst around the time of the European sovereign debt crisis. But he left immediately after Mario Draghi's whatever it takes speech, because he must have felt that he had now learned everything he needed to know. So Pete will add a markets perspective to our discussion, presenting an interesting decomposition of the different drivers of sovereign bond spreads. So Pete, the floor is yours.
Thank you. So let me first thank you, the President and ECB for hosting this conference, and Isabel for the invitation to speak at this panel. The title of this short remarks is One Size Fits Some, and while it may be a bit provocatively said, there is some things that is outside the remit of the ECB that is hampering the monetary policy transmission in all go. So what we do here is basically try to decompose what is driving sovereign yield spread versus the OIS rate. So basically, what is the sovereign risk premium here? So we divide this into you can say country-specific factors that would be decomposed of a fiscal risk premium, a term premium, a funding rate, and a residual. So the idea is that we can identify what is country-specific and what is non-country-specific drivers on this. So the countries that we'll look at is Germany, Italy, Spain, and France, simply for the reason of liquidity, and this is the biggest issue where we could do this, because again, this is a meta study where we actually take this from a financial market perspective. And while we could argue that euro area is one entity, markets do really not trade it as that. That's why we would do it like this. So in the model, we say that the fiscal risk premium is captured by the CDS. The term premium is captured by the ACM model developed by Fed staff a couple of years back. And the funding rate is observed in markets by the T-bills. We need to differentiate what is peace times and what is war times. And this is maybe a bad choice of words in terms of crisis versus or stress times versus calm times, because in the case of stress, ECB needs to respond irrespective of really drives this spread widening. But at peace times, they need to be more vigilant about how they actually go about this. And then importantly, the residuals. So when we compose the sovereign spreads into these country-specific factors, we also look at the residuals, because the residuals is something we actually need to discuss, especially in these peace times. So, what we see in our results is that compared to the range of residuals between these four countries, that relative to the pre-GFC episode, we are actually seeing a more homogeneous monetary policy transmission across the bond markets. But at the same time, we also see it's slightly more diverse relative to the very large QE episodes we saw from 2014, 15, and onwards. But the reason why that the residuals are so important is because this captures both liquidity, scarcity, not least, because there's also the flip side of having large-scale asset purchases, collateral frameworks, and the liquidity operations that we saw back then. And most interestingly, when we dive into the discussions, especially in the case of Germany, I'm going to show that on a chart later, that we actually see these residuals going from negative to positive, because you see this less impact from the ECB's balance sheet on the bond market here. So, a case study that we also found quite interesting to look at was in the run-up to the recent rate hike cycle. So, as you all know, that ECB came with the first rate hike in July 2022, and in the run-up to that, there was building market expectations for increases in the policy rates. When we decompose this, we actually see what happened up until in the first half of 2022, that you actually see a term premium rising. And that's a feature, not a bug, of rising rate expectations. But the fact was that this actually had the risk of destabilizing markets. So ECB was right to respond to this, even though that you could say it is a term premium that is rising that. The important thing to say on this is also then that once you then calibrate these measures, you need to be very, very diligent on how you actually do it. So you need to do it in a way that you do not actually lift inflation expectations further on. So in this instance, you would say ECB was right by announcing the then to be CPI after the ad hoc meeting, but it was also very, very important that the calibration was done in such a way that it addressed a transmission problem and not actually an inflation problem. So kudos on that calibration on that one. Now, if we bring it to the discussion to today, coming back to what we saw in Germany, that you especially see that you see a reduced market footprint, that the scarcity premium is essentially gone. And if we even zoom in on the most recent announcement from the German government in terms of fiscal plans, we actually see that as a rise in the term premium. Again, you could also argue, when you look at it, it's not something that central banks or per se should actually respond to unless there is a destabilizing risk in this episode of this. And finally, I would also say when you look at the most recent case for Italy, if you then look at the past 2 years, what is also interesting is that you see the spread tightening is actually driven by the fiscal policies. It's the CDS that's really compressing that. Again, I would actually say that's a rather healthy sign. So, if you look in this policy recommendation into what we can bring to this, I would say ECB is in a very, very good state. The monetary policy transmission is in a very good position across. We see that with the bond market pricing, as we just described there. A reason for that, not least being the fiscal stance that is more solid than it is. But at the same time, we should also be careful not to overdo a potential stimuli, because I would be surprised if we have seen the last acronym of some kind of policy response, because eventually a crisis will happen, but that needs to be very, very carefully calibrated, that crisis. Is it the job necessarily for ECB to compress this spread in residuals? Not necessarily, because many of these things is actually outside the remit of ECB. We are talking about the capital market union, for example. That is something that you actually can compress these residuals. Is that something that ECB can do much about? Not in the current position, but until then, we end up in a situation, as I write on the slide, that you have one size of monetary policy that will only fit some. And that means, in case, as I said before, you will end up actually have to invent new policies to address fragmentation should it happen. I'll leave that with the words. Thank you.
So thank you very much, Pete. So now we know that monetary policy is in a good place, the monetary policy strategy is in a good place, and monetary policy transmission is also in a good place. So thank you for that. So we move on to our final speaker, who is Refet Gökhanak, who's professor at Bilkent University. So he has been one of the most influential researchers and public voices in monetary economics and financial markets over many years, not only through his well-cited work published in top-tier journals, but also by directing the Monetary Economics and Fluctuations program at the CEPR. He also, as I learned, has some central banking experience, having been an economist at the Federal Reserve Board some 20 years ago. And he confessed yesterday at dinner that he's a central banker at heart, which is a good thing. And one reason why it's so good to have you on the panel, Refet, is that you're always able to surprise us with some unconventional thinking. And in fact, you will tell us that capital markets union is already there, at least partly.
As exemplified by this panel, every discussion about the euro area monetary policy is accompanied and usually led by its heterogeneity, how different the countries are from each other. This is wrong. It's not wrong that the countries are there and they're different from each other, but it's wrong that this takes precedence over the euro area aggregate. It's really important to remember that the euro area itself is a legitimate economic entity and that the ECB has a mandate defined over it. Heterogeneity is everywhere. Every single central bank resides over an economic aggregate that is composed of different agents, different smaller aggregates. But it's only when it comes to the ECB, the discussion of heterogeneity is before the discussion of the aggregate. Why is that? I submit to you that a lot of the answer has to do with the fact that the countries are there, and we're used to thinking in terms of countries. Is this an argument? It's more like an admission of cognitive limitations that we have to grow out of. A recent call for action on questions that are relevant for European monetary economics tackles this issue and makes 2 points. One, respect the euro area as the relevant economic aggregate. And two, when thinking about heterogeneity, look beyond the countries. That heterogeneity is consequential. It does matter. It matters because we need to understand how subunits aggregate up to the objects of interest for policy purposes. It matters because we have to understand who is being helped and who is being hurt by policy, and that differential helped and hurt creates important political economy issues that are also consequential for policymaking. In the euro area, when we talk about heterogeneity, immediately we begin thinking about, how different Portugal is from Belgium. But is country the obvious unit of analysis when thinking about heterogeneity? That's an empirical question, and one that is answerable, because in Europe, we have data on granular observations that are second to none. So we can do analysis on any levels of aggregation that we would like to. In work by the same great Altavilla, but different great paper, the data comes from Unicredit, the central registry of bank loans in the euro area. By looking at tens of millions of bank loans, we can ask, at what levels of aggregation are the bank loan spreads, the loan rate over the safe rate, the OIS rate, common? Are these, or to what extent are these summarized by the country, the issuing bank, the receiving firm, and residual idiosyncratic variation? Ta-da! It turns out half of it is country. So if you thought country really matters, it does really matter. On the other hand, if you're so obsessed about this half, it's perhaps worthwhile to think about the other half as well, which is the banks, the firms, and a little bit of idiosyncratic variation. That heterogeneity is carried over to monetary policy transmission. I'm not going to spend much time here, but monetary policy tightenings behave differently from monetary policy easings. And in particular, QE has not only tightened the sovereign spreads, but has helped the bank loan spreads at the level of the banks and at the level of the firms. It can also show that this was particularly driven by those banks and firms that needed the help the most. So, good job. Now, given that country is the single most important determinant of bank loan spreads, should we conclude that, see, we knew it? If we're thinking about funding cost of firms, look at the country. That still is an empirical question. And for that, we can turn to corporate bond market. In work by two outstanding ECB economists, Livia Kitsu and Sofia Gori, the corporate bond market is subject to a similar analysis. And unlike bank loans, since corporate bond prices are publicly observable, this can be done comparatively between the US and the euro area. So we can ask, for monetary policy transmission to corporate bond spreads, how important is the issuing firm's state in the US and country in the euro area? No one here is going to be surprised that in the US, state doesn't matter. This is almost a sanity check. You will be surprised to learn that in the euro area, country doesn't matter either. Why is that? In fact, what determines corporate bond spreads in the euro area? We can do a similar analysis and ask how much of the corporate bond spreads are common at the level of states in the US and countries in the euro area. In the US, it's a negligible fraction. In the euro area, it's as negligible. So what is it? It's the issuing firm. That's what determines the spread. Now that begs the question, why the difference? It's either that, sure, these are bond issuing firms, not your corner store, right? These are older, larger, they are just different every which way. It might also be that, no, it's the bond market that's actually different. This is a question that's answerable because we have these firms' bank loan rates as well. If the firms are special, their bank loan spreads should be divorced from their countries as well. So we can check for the bond issuing firms how much of their bank loan spreads are common at the level of their countries. And the answer is 70%. It's not that these firms are special in this regard. In fact, I'd like to argue that it's not that the bond market is special either. It's banking that's special. When I told you that in bank loans, 50% is at the level of the country, you may have thought, which country? Country of the lender or country of the borrower? And the answer is, it doesn't matter. 94% of bank loans in the area are between institutions in the same country, banks and firms. If you do this value weighted, this is value weighted. It's a staggering 85%. Banking is local business. If you look at, this is for all firms, if you look at only for bond issuing firms, there are almost no cases where less than 70% of the bank loans are between institutions in the same country. Banking is very local, even for the largest firms. What about corporate debt? If you turn to corporate debt, and in Europe, we have data on this too, so we know who is holding the corporate debt. How much of that is held inside the country? Never more than a half, usually much less than that. And this is the entire holders inside the country. If you ask how much of it is the local banks, never more than single digits. The last bit here is to ask, how closely tied are these to the sovereign? So what we're going to look at is to ask, look at the sovereign spread, so the municipal spread for US state bonds and the sovereign spreads for the Europeans, and regress that, or use it as the regression, for bank bond spreads and non-financial corporate bond spreads. The whiskers are the confidence intervals, so they include 0, telling us that there is no statistical story to be told for the US, neither for or either for banks or for non-financial corporates. In the euro area, it's the same for the non-financial corporate bonds, but bank bonds are intimately tied to their sovereign spreads. Banking is local business, and banking is very affected by the sovereign in the euro area. It's those two things that make banking special. I dumped a lot on you, so let me recap. And I hope you're going to remember these bits from this presentation. One, respect the euro area as the legitimate unit of analysis. It has to come before its heterogeneity. Two, banking is special. Banking is a relationship, or a bank loan is a relationship between one borrower and one lender. Who that lender matters a lot. And for banks, where that lender is matters a lot, because banks and sovereigns are intimately related to each other. That's not the same for corporate debt. Corporate debt is one borrower, many lenders, diffused over a wide geographic area. Hence, no such country-based heterogeneity here. This is the sense in which, although we are very happy to bemoan the lack of a unified capital market in the euro area, for corporate debt, unification doesn't get deeper than this. It's already there. It does also suggest an obvious policy implication. If country-based heterogeneity is seen as a bad thing per se, and maybe it is, maybe it isn't, but if it is, and if it's impossible to divorce the banks from their sovereigns, then get your firms to issue more corporate debt. That seems to be a natural policy implication. Thank you very much.
So thank you, Refat. You didn't disappoint my high expectations. Thank you for being provocative as always. So I would like to give the four of you the opportunity to respond to whatever presentation you would like to respond to. You want to start, Agnes?
Thank you. So I would be happy perhaps to follow up on what Refat has just said, because we know that the corporate bond market in the euro area is much for big firms. And in my view, the Capital Market Union or Savings and Investment Union is also for the extensive margins to allow smaller firms to issue corporate debt. So I know you've looked at the country-specific component for firms that issue corporate debt, but I think it would be interesting also to see how new firms can issue debt and whether the conditions compare with what they get in terms of bank loans. So, so in a nutshell, I think it's not the end of the story.
Of course not. You're absolutely right. It is actually the case that the corporate bond issuance in the euro area has been changing in ways that is very positive over time. So if you look a decade ago, the US and European by size issuance distributions are very different, right? Now, euro area has more or less caught up in terms of smaller firms also issuing. But overall, corporate debt in the euro area is still much less than that in the US. Yeah. It's not very clear to me why that is the case, whether this is a regulatory issue or just an awareness issue.
And those who issue the debt are also multinationals. So it's not just that the holdings are diversified, but also the markets are diversified.
Some, but not all, yes.
You have a comment?
Yeah, I also wanted to build up on what Refat said, because I think why do we care about countries in a monetary union? Because we have limited risk-sharing mechanism. We don't have a fiscal union, and capital markets are imperfect. So to me, an interesting question is to understand whether we can scale up the bond market so as to achieve a union in which the return to saving of the citizens of the union gets more or less equalized across countries, because that would introduce a dimension of risk sharing. So to me, that's the scaling up is an interesting question, whether we can do it.
Sure. This is true in very many ways, right? I mean, within countries, we don't have perfect risk sharing either, which is what leads to a lot of the wealth implications of cycles. And that's particularly true for the euro area. This is one of the things that I see as, it is what it is. It's not that monetary policy can do anything about this. But I am of the opinion that this is a politically fixable problem. And we should not be thinking of this as the ECB's problem, but the EU's problem to be solved.
Question for Agnes, and especially your or heterogeneous impact of the GDP and inflation, if you have done this similar analysis, say 10 years ago, to see if it's more diverse or more homogeneous now?
So we've not done it, but there are some data limitations on a country-by-country basis. You see the confidence bands are already quite large, but we could, it's a good idea. Yeah.
Let me quickly ask you, you were talking about the sovereign debt market doing better in many ways. But is that because overall, things are better? So, or have we systematically fixed something? If we face stress similar to the European debt crisis, for example, do you think that we're going to see fragmentation that's as bad again?
Well, there are certain things that limits this transmission. For example, the doom loop between banks and summers are yet to be fixed. So if we see a similar crisis as the summer occurs, I'm sure that we will see stress again. Question is, since then, we've actually had a framework, not least the different bond buying purchase program, the CPI and so forth, that can limit that. But we're still going to look to the more vulnerable countries first off, and that's why, well, policy initiative to backstop this is quite important. But I would say the tail risk is gone. The tail risk is gone.
Very good.
Thank you very much. So I would like to open the floor. So I see Joachim already. Okay, so we start with Joachim.
Thank you so much for this rich discussion and the presentations. I have to come back to Agnes' points because this is a very relevant one. If you take the corporate issuance or the relevance of the corporate sector regarding the bond market in Europe, it's 5 times less than the United States, 5 times less. So there could be you could argue, okay, we are improving and things are evolving, but many of the SME companies do not have access to the capital market because the capital market for them is super complicated. It's very heterogeneous. They cannot handle it. They cannot manage this. So the large corporates, they have all the capabilities. They can do this. So what I would like to say with this is that it is too good to be true that we have this capital market union. Reality is not there because I believe that the results are to a certain extent distorted by the fact that both markets are so different.
I should stress that this formulation, of course, was just my provocative summary, right? So he didn't say it, that capital markets is already fully there. So I have Christine, Holger, and, okay, so Loriana, and then I move over here.
Thank you.
And after those 3, we have a short answers, please. Oh, Francois. Okay, I take you as well.
Kristen Forbes from MIT. I want to ask about a source of heterogeneity that you barely touched on, which is differences in the fiscal stance and fiscal sensitivity to shocks. Not debt necessarily, because fiscal policy is not always tightly linked to debt levels, which Luca talked about. But let me just give a concrete example. After COVID, as countries were raising rates, the US had a very expansionary fiscal policy, and that mitigated much of the effect of higher rates on the economy. Stronger growth, stronger employment, probably higher inflation might have required even higher rate increases. In Europe, is there a big difference in the fiscal sensitivity of, say, to shocks? So is there more automatic adjustment across different countries which would affect the transmission of monetary policy?
So given the long list that I have, please be as short as possible as you can in your questions. Holger.
Okay, Holger Schmieding, Berenberg. I'm interested very much in this high debt, low productivity nexus. Of course, it sounds like a stylized description of Italy. But if I look at which country in Europe recently for the last 5 years has not grown, it's low debt Germany. And secondly, is this high debt, low productivity a forecast for the US, where currently we see high debt, high deficits, and high productivity? Can that last? Or is that the country that simply does not fit the description.
So Lauriana and Francois, and then we give the floor to the panelists.
So thank you very much, Loriana Pellizzon from SAFE, Goethe University and Ca' Foscari University of Venice. I have a question for Pete. He was mentioning, the fact that this residual can be affected also by scarcity. And so the question is, how much really the ECB can do on this issue, maybe by enlarging the security lending facility or reducing the spread? And then I have a question for Refet. It's true that in Europe we have this capital corporate bond market, but on top of on the fact that it's not so large, it's far less liquid than the one in the US. And it's not going to help the small and medium enterprise. The question is how much securitization eventually can help on this direction. Thank you.
Francois? And you can already prepare your short answers, if you can.
No, thank you very much to the four presenters, with a special mention for Agnès, which you will understand. But no, two short remarks. First, about Capital Markets Union. Can I introduce another elephant in the room, which is equity? I think our main gap of funding for corporates compared with the US, it's not in the bonds. It's not in the partition of debt between bank and financial market. It's a shortage of equity. I don't know if it has consequences for monetary policy, but I'm sure it has deep consequences for European innovation and growth. And Capital Market Union is mainly about equity. Second, coming to Agnès' presentation, in the second slide you presented, could you come back to this issue of fixed rate versus short-term rate or variable rate? Because I think this is the main heterogeneity we have. I would advocate a large role for fixed rate because I think it does not hamper in the medium term the transmission of monetary policy, but it improves financial stability. But could you elaborate a bit?
All right, so who wants to start? You start, Pete.
Because on the question for Christian about the sensitivity to shocks, I would say we don't have much data to really backtest this across horizons because all crises are different. But I would claim that the sensitivity has gone down, given that we've removed the tail risk of a euro breakup over the past 15 years. So I would say that the sensitivity has gone down, but I don't have numbers on how much that has gone down. And the question on the residuals, I would actually say that ECB can do quite a lot because part of the reason why we saw these negative residuals during the period was a flip side of the large-scale asset purchases and the collateral frameworks that there was there. So they do actually have a large role to play. But that has been unwound. That's why I would actually say we see more healthy bond markets now on this, and especially it's the German case to be quite direct. That is what has been lacking. Could security lending do something? Certainly it has mitigated it, but it's just different. It all comes down to the price, but it's just different whether or not you actually have the cash collateral or you go to the ECB operations to do that. But good questions. Thank
you.
So in terms of the fact that issuing corporate debt in the euro area still isn't easy, that's absolutely correct. The point about unification is that conditional on having issued, it doesn't matter where you reside. That's the sense in which that market has unified. In terms of the issue about equities, that's not something we studied yet, but that's clearly important. And I agree with you that when people talk about capital markets, that's what they have in mind. Like public equity, private equity, in particular things like venture capital, right? And those are the markets that are much smaller and much more fragmented in the euro area. And for Lauriana's point, it's going to depend. So whether securitization is going to help. This is a question about, there are still a lot of bank loans. Banks are tied to the sovereign. So perhaps we can make the bank loans look more like corporate debt by packaging them and having them market traded. The details are going to matter a lot, right? If you are able to structure these such that they are truly independent of the issuing bank is going to work. If the bank is going to continue to matter, then it's going to look like a bank loan nonetheless.
Okay, on the relationship between high debt and productivity, of course, there are many determinants of productivity, and even we would not expect to have a stable relationship between debt, investment, and productivity, because, for instance, this will depend on the borrowing cost that the government will face. A high borrowing cost makes it more likely that the government will implement fiscal measures that reduce investment. And also the fiscal stance matters a lot. What do you do with this public debt? So a country might issue public debt to finance public investment in R&D. We would expect growth to pick up, actually, not to decline. And the last point that I want to make about this is that the relationship might be very nonlinear. So it might be that you start seeing the effect of fiscal policy on growth when the fiscal position gets really bad, when you have a high debt and high interest rates, because that's when the government is going to start to grab money when it can. It's going to start to cut public investment, to tax firms. So that's what I'm worried about, that this kind of dynamics can be nonlinear and can shift the country from tranquil time to stagnation quicker than we would expect.
Thank you. Agnes? So, Christine, you raised a very difficult question, which is the one of the policy mix. And so in the euro area, normally there are the same fiscal rules for all the countries, so this is an element of homogeneity. However, the fiscal space obviously is different across countries, and also the political economy differs very much across countries. So you don't get the same patterns across the different countries, and there could be a source of, this could be a source of heterogeneity. However, I would not overplay the difference between euro area and non-euro area countries. In our report with Giancarlo Corsetti and Elga Bartsch and Xavier Dobrun, we looked at that, and actually the congruence of monetary and fiscal policy is the exception rather than the rule, I would say, both in euro area countries and non-euro area countries. So it's not so specific to euro area countries. As for my governor's remarks, so of course he's right. So I think that what I try to show is that the length. So you have two channels of transmission to non-financial corporations. One is the rates on new lending, and there is not much heterogeneity across the countries. And the second one is through the revenue channel of monetary policy, and here you have a very large heterogeneity that does protect the borrowers in the short term when there is an increase in policy rates. And I think this has been very instrumental especially for high debt countries, over the recent cycle. From a macroprudential point of view, you could say that this has protected the consumption, it has protected the macro, and of course now we need to take into account the fact that, for instance, the French firms won't see the effective cost of their debt fall until 1 or 2 years, because there are still some firms that are rolling the debts that they contracted before the inflation cycle. So we need to take this also into account when we measure the stance of monetary policy, because in some countries there could be some long effects of past monetary policy tightening. So this would my take. Thank you.
Thank you very much. So in the next round, we have Bea, Hélène, Ricardo, and I think, yes, so of course I want to ask our young economist who's worked on these topics. So Leonardo, right? So Beatrice first.
Thank you. Beatrice Vela Di Mauro, Graduate Institute in Geneva and CEPR. My question is basically to Refet. You focused on the corporate bond market and impressively showed its integration and concluded we want more of this and for more companies. But you also showed the problem of the banks, essentially, and you did not focus on that. So I wonder why. After Draghi last year, there was a bit of a dynamic discussion about banking integration and consolidation across Europe and across borders. This now seems to be stopped or at least dormant. Have we given up on that again, or should we give up and just focus on capital markets? Question mark.
Hélène?
Hélène Ray, London Business School and CEPR. So thanks for a very rich presentation. I have one question for Refet and one for Agnès. For Refet, so do you think this result on bank comes from precisely this fiscal monetary policy nexus that we have in the euro area? Remember, in the euro area crisis, we have the famous doom loop, right? And that's the overexposure of some banks' balance sheets to domestic sovereign debt. So to what extent do you think that may explain your results? I would be interested in your view on that. And Agnès, I think one source of heterogeneity that we tend to forget a bit is indeed this heterogeneity in duration of public debt across the different euro area country. When you have a lot of duration heterogeneity, for example, the Dutch debt has a much shorter duration than the Italian debt. And we have a long-term debt, which is, with well-anchored inflation expectation, priced with a 2% inflationary expectation, and we have long-term deviation from the target, either on the upside or the downside. Then these have very large quantitative effect on fiscal accounts, so very large wealth effects. So to what extent do you think that could be an important channel as well?
Ricardo?
Two questions. Imagine, hypothetically, in the present or in the future, that there was a shift in capital from the left side of the Atlantic to the right side of the Atlantic, and we had an abundance of capital that just flows, perhaps in searching for safety or perhaps of changes in current accounts. Agnès, do you think this is just like a monetary policy shock, or that has homogeneous impacts in the different regions, or is it very differential? Or Piet, do you think that it's, again, a capital inflow into Europe, say coming from the US, hypothetically, would lead to very differential impacts across different bonds, or would it be similar? And Refet, do you think that, again, the abundance of capital would have the same impact on bank lending as in corporate bonds, or would it be different? But moving beyond monetary shocks, and so we want to talk about heterogeneity, how would an external shock in terms of shifts of capital affect in a heterogeneous way across different dimensions? And then very briefly to Luca. Luca, your point at the end on how we needed some joint spending, I mean, we did that. It's called Next Gen EU. It was just 3 years ago. Will it have the very large multipliers and we're about to see them, or does it not quite fit into your story? But how does it seemed like the last 5 minutes you were talking about Next Gen EU, which we literally just did. So why does it not fit?
Thank you, Ricardo. So please, Leonardo.
Thank you so much. I have a question for Refet. I think the data is very interesting, and it's quite surprising to see such low spreads. But the one take on perhaps actually is that completing the capital market union is even more important because it's probably in these cases should be theory that guides us on whether it's important to complete these sort of unions rather than data. For instance, what we would like to observe are the spreads of firms that can't access capital markets right now because they're cut off. So the shadow cost of that, and that's unobservable in the empirics. And so when we go to theory, then we need to think of financial integration in conjunction with real markets. And the European Union is still a currency unions in which real markets clear at the national level, much more than real markets clear at the state level in the US. And so that should actually push us to think about countries, regardless of what the statistics on spreads on corporate markets show.
Thank you very much. So, who wants to start? You want to start?
So, thank you for many great observations and questions. Let me begin by combining my answer to Bea and Hélène. So, it's obviously true that we understand the mechanics of the doom loop and the relationship between the banks and the sovereigns, and in particular, some of it is the banks are holding a lot of sovereign debt. Some of it is if something happens to the bank, it's going to be the sovereign that's going to bail out or not. Right? And it seems to me that that link has not been broken. And that's the answer to part of your question, that we want to do. So one thing we can do is to say, look, countries are countries. Heterogeneity at the country level is what it is, and we're going to live with this. Okay? And we even say that there are better run countries with lower spreads and worse run countries with higher spreads. That's efficient. So what is the problem here? Okay? Or we're going to say, we just don't like this country-based heterogeneity and don't want firms to be punished or helped for being in country A versus country B. In that case, one of two things seems necessary. Either break the link between the bank and the sovereign, but that's the sense in which it's not broken more than a decade after the euro crisis, right? Or break the dependence of the firms on bank loans. That's the sense in which push them towards more market finance. And it is true that the hurdles aren't small, but this is a regulatory issue. It's partly awareness, partly telling firms, you could do this, partly making it easy and cheaper for them to do so. But one or the other, preferably both, has to happen. The political economy of making banks less state-dependent seems harder to me than the mechanics of getting firms to have more access to market finance. Hence, I'm pushing that bit. On Ricardo's point, if capital were to rain on the euro area, it's not going to be differentiated at the level of the countries in terms of corporate debt. We've done this every which way. And really what matters is if you're a good, worthy of financing company that is trying to issue a corporate debt security, and you're large enough and you're entrepreneurial enough to do so, you are able to do so. And it's not going to matter that you're from country A or country B. Okay? And since that's already the case, getting more capital is not going to make it worse. It's only going to make it better in that regard. For bank loans, I don't think having more access to capital is going to help banks that are seen to be in worse countries. Okay? That's something that's already observed. And again, that's not going to change if we get so lucky that suddenly there is an abundance of capital here. Okay? On the issue of markets clearing at the level of the countries, I don't think that is factually correct for the corporate debt market. That actually is the essence of the argument here, that corporate debt holdership is diffused enough that the issuer's country isn't the relevant level at which that market tries to clear. Hence, the unification of that market. Thank you.
Thank you, Rafet.
Yeah. So the question from Ricardo just before regarding the flows, I would say it depends. I know it's a boring word to say as an economist, but it really depends on what kind of environment that we're facing. Because if it's a high volatility environment, I would say it has a much different impact than it's a low volatility environment. Then we also have to factor into account how big is the bond market that they are trying to achieve, because we do see, such as, for example, Italy. In the case of Italy, in a low volatility environment, that would probably attract more funds simply because of the sheer size of its issuance market. Could it also be happening to equities, of course, and potentially you could also take this opportunity if you actually want to build a proper EU curve that could also be traded across the financial market in a larger scheme, could also be something that will not have a heterogeneous impact, of course, if it's just one name, but yeah, the boring answer, it would depend on what kind of environment that we face when we're there. That was the short answer.
Thank you.
Yeah, about Ricardo's point, about what would happen if a large inflows of capital were to hit the EU, I would be worried about the future of productivity, because we've seen many countries, Spain, Portugal, that got very large capital inflows. These capital inflows were directed toward low productivity sectors, and productivity growth stagnated. So I would think of where this capital is going. And about next generation EU, I think you're spot on. So it's too early, I think, to assess the impact of these kind of programs on productivity. I tend to be an optimist, so I think and hope that these programs contributed at least to reduce the divergence in productivity. But now I think that the constraint on growth in the euro area and in Europe is really the lack of high-tech activities. And to stimulate that, perhaps we want to think about something else. We want to think about public R&D programs, which look like they work very well in the US, at least according to the best evidence that we have, or public-private R&D partnership. So kind of policies coordinated at the EU level that can jumpstart high-tech sectors.
Thank you. May I mention a research by Banque de France showing that the monetary policy transmission is different whether when firms are financed through bank loans or through market issuance. This, if this corporate bond market expands, then this could actually accelerate the transmission of monetary policy onto through investment at the firm level. So interesting to follow. On Ellen's question about, so I didn't mention the maturity of public debt. Obviously, it matters. There is a complicated political economy here, because in the short term, when you have a surge in inflation, since the maturity of the debt is relatively long, then it doesn't show up immediately, except for the index bonds. It doesn't show up immediately in interest payments. However, it apparently reduces the debt burden. But we know that most government expenditures are actually indexed, or that follow inflation. So this is just a mirage. And afterwards, so this is where we need to distinguish supply versus demand shocks. Because if inflation is driven by a supply shock, then you have a negative impact on growth, whereas when it's driven by demand shock, you have a positive impact on growth, and this is what matters at the end of the day for the debt accumulation. Yes, this needs to, and it brings me back to the question about the policy mix in case of a demand shock versus a supply shock. And for Ricardo, I have no simple answer, so I would need to think about it.
Excellent. So we have two final questions. So Silvana and Yanis.
Thank you very much for a great panel. This question is for Agnes. So if nominal rigidities or the mortgage structure do not affect the transmission of monetary policy, as you showed in your results, what's, in your view, the main channel for monetary policy transmission in the euro area?
Very similar, actually, question. Agnes, you referred to differences in wage indexation in EU countries, in Eurozone countries. So do you have evidence that the degree of wage indexation, either statutory or coming from labor market pressures or union pressure, play a role in the efficiency or the transmission of monetary policy? And if yes, does the same apply to fiscal policy?
So it's all to you.
Okay. Thank you. Very relevant questions, actually. I would say that there are many heterogeneities in monetary policy transmission, but apparently they tend to cancel each other to a certain extent. So if you only look at aggregate GDP, the impact on GDP or inflation, then you don't see very striking differences across countries. Whereas if you look at investment, consumption, the mortgage market, credit, you will see differences. So I'm not downplaying the existence of the heterogeneities. It's just that for monetary policy of the ECB, it may not be as relevant as other forms of heterogeneities across big versus small firms, different types of households, etc. And sectors, of course. So what would be the main channel then? I think all the channels are relevant. What was struck me is the first slide, the first graph I showed with the interest rates on new loans to non-financial corporations that seem to evolve the same way, at the same pace, even though there are fixed rates, variable rates, long maturities, short maturities. On average, it doesn't seem to be. So this must be a key driver. And of course, also, the interest payments, and as François said before, it's just a question of timing. So in some countries it's immediate, but in some countries it will take more time. But at the end, the monetary policy transmission will be complete in all countries. So it's just the timing that is a big difference.
So thank you very much to our 4 excellent panelists and to our great audience who asked many interesting questions. So we come to the end of this first panel, and I will try to summarize very briefly. So I think the one summary we can have is that heterogeneity matters, but maybe we should focus less on the heterogeneity across countries and, by the way, as we do in the Governing Council, focus on the euro area as a whole, while of course also looking at the various other dimensions of heterogeneity like sectors, firm sizes, type of financing, and so on. So I think we also have to admit that the one country level heterogeneity that matters a lot is fiscal policy. And there is a need to deal with that going forward. I think that's not up to us. It's up to governments. The same is true for all the various aspects of integration that we've been discussing, particularly the integration of capital markets. So we will play our role in that, but there are others who have to do the main work. So thank you very much for a fascinating panel. Thanks to all of you, and enjoy lunch.
I'd just like to say a quick thank you to Isabel for doing such a wonderful job of summing up, to all of the panelists for providing so much food for thought, and with that we will break for lunch. If you could please be back in the room by 2:30 p.m. promptly for our policy panel, then that would be great. Thanks a lot.
We are facing major structural changes related to aging, digitalization, greening of the economy. And with all that, we have to deliver on our mission, price stability. So if you're interested in those issues, come to the ECB Forum in Sintra. We will debate all that and more.
Welcome back after lunch. I'm delighted to announce one of the highlights of the ECB's Sintra Forum, our policy panel. The world economy is undergoing a period of rapid and intense change. The questions of our next panel, the questions for our next panel will cover what these fundamental shifts mean for the future of monetary policy, and we are honoured to have an exceptional lineup of officials to answer them. We are also honoured to have Francine Lacroix, anchor and editor-at-large at Bloomberg Television, to be guiding the conversation. Francine, the floor is yours.
Hello, everyone. Claire, thank you so much for that introduction. What can I say? We have 1 hour and there's a lot to discuss. So welcome to the policy panel, Sintra 2025. Now, from tariff-related trade ructions to oil price gyrations, caused by also Middle East hostilities. There are many questions on, first of all, how to handle the fallout from some of the political decisions, but much more how the economy behaves. Now, 1 year on since the last Sintra panel, and of course, halfway through 2025, global policy needs to navigate risks posed both to inflation and growth, a challenge highlighted by the Bank for International Settlements in a report this week. So let's get started. We have 1 hour. Kazuo Ueda, Governor, Bank of Japan. Of course, our host, Christine Lagarde, of the European Central Bank President. We have Jay Powell, Chair, Board of Governors of the Federal Reserve System. We have Chang Yong-ri, Governor, Bank of Korea, and then Andrew Bailey, Governor for the Bank of England. Madame Lagarde, let's start with you as our host. So first of all, thank you so much for having us all here. We had a little bit of data today, this morning, consumer prices rising some 2% from a year ago, up from May's 1.9%. But then the tariffs still loom large. So how do you see that developing?
Well, first of all, I would note that we are at 2%. And this is the latest reading. This is also the target that we have had, and this is the projection that our staff is indicating for the medium term, which is exactly what we had anticipated. So I'm not saying mission accomplished, but I say target reached, okay? And I think we should start by recognizing that. We faced a massive amount of shocks, compounded shocks occasionally, and we are now through that disinflationary process that we have conducted over the last 2 years. And yes, we are facing a lot of uncertainty. Yes, we are facing the risk of fragmentation increasing. And yes, we are facing geopolitical developments that are worrying generally, but that also are causing two-side risk to inflation. So we have to continue to be extremely vigilant. We have to continue to be committed to delivering on our target. And I think we are at this point in time in a very good position to do that. So we are well equipped to navigate the tormented waters that we should anticipate.
Chair Powell, tariffs are not yet showing up in inflation. Is this forcing you or your staff to actually rethink what the models say about how much the tariffs will ultimately through some of the final prices?
So thank you, Francine. And Christine, thank you to you and your colleagues for putting on another great conference here today. It's been a pleasure. I guess I would start, if I may, by saying that the U.S. economy is in a pretty good position. Inflation has come down close to 2%. We're at 2.3 headline, 2.7 core. The unemployment rate is at 4.2%, so we're healthy overall. If you ignore the tariffs for a second, inflation is behaving pretty much exactly as we have expected and hoped that it would. We haven't seen effects much yet from tariffs, and we didn't expect to by now. We've always said that the timing, amount, and persistence of the inflation would be highly uncertain, and it's certainly improved that. So we're watching. We expect to see over the summer some readings, higher readings, but we're prepared to learn that it can be higher or lower or later or sooner than we'd expected.
But, Chair, would the Fed have cut more by now if it weren't for the tariffs?
So I think that's right. In effect, we went on hold when we saw the size of the tariffs and essentially all inflation forecasts for the United States went up materially as a consequence of the tariffs. So we didn't overreact. In fact, we didn't react at all. We're simply taking some time. As long as the U.S. economy is in solid shape, we think the prudent thing to do is to wait and learn more and see what those effects might be. And again, they haven't really shown up. So for now, we're waiting.
Governor Rhee, I mean, South Korea's economy is, of course, highly reliant on trade. Putting aside the deals that each government can strike with the Trump administration, what can central banks, in your position, do to shield economies from the impact of trade tariffs?
Actually, about the tariffs' impact on inflation, our current inflation is well stabilized around 2%, and we believe tariff tends to be deflationary rather than inflationary for three reasons. One is Korea is not likely to use retaliatory tariff. Second, we import 22% of our import from China, and recently export price of China has been falling at 5% a year for several years, and we believe that it will continue to do so. And at this moment, our growth rate is 0.8%, which is well below our potential growth rate. So aggregate demand pressure is much lower. So our problem is not the inflation itself, but the gross impact of tariff.
So what does that mean you'll do going forward?
Yeah, actually, we have been in an easing cycle, and we cut our interest rate 100 BP from last October. And we will continue to be in an easing cycle given our growth rate. But recently, financial stability risk has been rising, especially housing price in metropolitan area is increasing very fast. So we are keeping an eye on this financial stability risk in deciding the pace and the timing of the further cuts.
Governor Bailey, you've taken the view that the latest rises in inflation in the UK will be transitory. Why are you so confident that inflation will fall back?
Actually, you may have detected I've tried to avoid using the transitory word because it has, oddly enough, it has a bit of a history. But to be serious, obviously any increase in inflation is an increase in inflation, sorry to state the obvious. The reasons it's gone up is really entirely due to so-called administered prices. Now, that's, as I say, that's an increase in prices, don't get me wrong. But it's not telling us much or anything about the context of the economy. In other words, it's not telling us anything really much about the balance of supply and demand in the economy. So I think the key judgment for us is, are we going to get second-round effects from this this pickup? And of course, it's nothing like the pickup of a few years ago, just to be clear. And my judgment is at the moment is that the context is different, that we do see evidence. I see some signs of softening in the economy, I see signs of softening in the labour market. We are going to have to see those come through, though. I mean, come through into prices. I think we've still got to see the evidence and prices. But that background context allows certainly me to say, look, I think the direction of interest rates continues to be downwards.
When you look at all of the uncertainty, again, it's a bold call given what happened to oil prices and trade negotiations?
It is. I mean, I would say two things on that. One, I think as others have said, it's probably, Jay was saying, I think it's a bit too soon, I think, really to see the price effects coming through from the trade and tariffs action. We've made a point of saying also that, I think as Christine was saying, that these are two-sided. They could go either way, could be weaker demand, we could see supply chain disruption. And the second thing, of course, is that some of these effects, if you take the oil price story, it's gone up, it's come down, all since our last meeting, effectively. So, we always reach for the lexicon at this point. I mean, we've added unpredictability to uncertainty. I was slightly amused at the introductory film this morning with Christine saying all these words, because it's true. Because not only are we getting uncertainty in the sense, the range of outcomes, but unpredictable in the sense that if you get things like, the tariff action, history really isn't a particularly good guide to that, actually. You can't really draw much from the past on that.
Now, Governor Ueda, you're in a slightly different situation, right? Japan's CPI has stayed above 2% for 3 years now. What do you see as the fundamental changes in your economy that make inflation more persistent?
So let me say, to put it simply, as you say, headline inflation has been above 2% for almost 3 years, while what we call underlying inflation is still somewhat below 2%. That's the situation we are in. But if I could decompose it further, there's probably about 3 components to it. First, there's underlying inflation dictated by wage price dynamics, whereby increases in prices affect wages, which further affect prices, helped by resilient domestic demand. This component has been going up slowly. But as I said, it's still somewhat below 2%. Then there's going to be perhaps a second component, which will be the expected negative effects of possible tariffs on the economy and on prices. We are expecting this to take place, but we haven't seen that yet. There's a third component, which is a domestic supply shock generated by increases in food prices. Actually, this component accounts for about 50% of the headline inflation we've got at the moment. So netting these 3, we think the first component and the second component will produce a slow increase in underlying inflation toward 2% by end 26 or 27. The third component, food inflation, is going to subside toward the year end. So that we will be closely monitoring interplays between these 3 forces.
But, Governor, how do you view trade concerns the day after President Trump threatened Japan with more tariffs?
Well, it's being negotiated by our minister in charge, so I'm trying to avoid making any specific comments on this.
So let me just ask you, what will be the key trigger for Japan for deciding further rate hikes?
Okay, as I said, it will depend on the relative strength of the 3 inflation dynamics I was describing, and we need some more information to determine that.
President Lagarde, when you look at rate cuts, I mean, are we gonna, where do you see actually the ECB going? You're in a pretty comfortable position right now out of all the central banks.
Data will tell. So I think we are determined to continue to be data dependent, to decide meeting by meeting, and to not commit to any particular rate path. That's the doxa. And we're very lucky because we have just completed our strategy assessment, which really gives us a good framework and good strategy lines within which to operate. But those 3 aspects that I have mentioned, data dependent, meeting by meeting, no commitment to any particular rate path, are constant in that ongoing strategy based on what we have concluded actually yesterday.
Jay Powell?
So from our standpoint, as you will have seen, a solid majority of FOMC participants do expect that it will become appropriate later this year to begin to reduce rates again. And so, that will depend, though, as Christine just mentioned, on the incoming data. We'll be monitoring particularly what does show up in terms of inflation or what does not show up, and also carefully watching the labor market. You know, we watch very carefully for signs of unexpected weakness. We see a gradual cooling, but we don't really see that yet. So those are the things we'll be watching. But as I mentioned, a majority of us do feel that will be appropriate in the remaining 4 meetings of the year to begin to reduce rates again.
Madame Lagarde, the euro has also surged about 12% against the dollar so far this year. Are you concerned that its strength runs counter to your efforts to also loosen financial conditions?
You know, I'm not going to comment on the exchange rate. We take it into account for purposes of our projections. Obviously, it has an impact, but it's a reflection of the market conditions and assessment. It's also a reflection of the strength of our economy. But there has been a clear appreciation relative to the dollar, and depending on how you look at it, it's either a depreciation of the dollar or an appreciation of the euros. And there might be a bit of both in that particular case. We're also looking at the movement, the flow of capitals and the attractiveness of euro-denominated assets, which is also an interesting phenomenon that we've observed lately.
Chair Powell, I mean, is it fair to say, I know, nothing is guaranteed, number one, we all know this. Barring a real surprise, is July just too soon to seriously even consider a rate cut?
Yeah, I really can't say. It's going to depend on the data, and we are going meeting by meeting. I mentioned, how I'm thinking about that, but I wouldn't take any meeting off the table or put it directly on the table. It's going to depend on how the data evolve.
Governor, what's the biggest risk stemming from protectionist trade policy, actually, for the global economy and for South Korea's?
Can you just...
The biggest risk stemming from trades and protectionist measures?
That Korea has a quite export-driven economy. So whatever the global fragmentation has a serious impact, not only direct impacts through the U.S. tariff, but also indirect impacts through China, Mexico, Canada. And we easily can... It really depends on what's going to happen on July 9th. We are actually waiting for the result, but we don't know what's going to happen. But for example, like if the tariff goes back to 26% retaliatory tariff that was announced in April 2nd, and then also with a lot of sectoral tariff which affect our economy, aluminum, steel, and cars, we can easily say that it has an impact larger than close to 1% in our GDP growth rate. And depending on how long it lasts, I think we have to adjust to the new supply chain, so the impact will be larger. But I hope that scenario won't come.
What is the most concern for the Bank of Korea? Is it a stalling South Korea exports, slowdown in global trade, or a downturn in the U.S. economy?
It's all linked, right? It's all linked, right? So it's a global economy slow down. And one thing, I mentioned some negative sides only, but one positive side, I don't know if it's positive or not, but Korean companies has been preparing for the supply diversification long time ago before the tariff, U.S. tariffs start to, because we have some issues with China, and then also Chinese industry has become very competitive. So we had to relocate our production site from China to elsewhere. So relatively speaking, we are well prepared. And second, still good thing is that we have some strong industries such as semiconductor, which benefit from the AI technology development. So I hope that we can manage it. But on the other hand, given we look at the sheer size of the export dependence, we will be significantly affected.
Governor Bailey, do you think interest rates will be closer to 3 or 4% at the end of the easing cycle, given all of the inflation and trade dynamics?
That's a subtle way into the R-style question, actually, I would detect. So look, I'm fairly cautious about the whole discussion of the level of R-star and therefore sort of where rates are going to reach in the cycle. There is huge uncertainty around it. What I think is important, and what we spend our time looking at, is how restrictive is policy, both now and going forwards. And our staff do a huge amount of work on that front to judge the restrictiveness of policy in the current context, and how restrictive it's going to be looking forwards if you project forward with the market curves. And the assessment we've got at the moment is that policy remains restrictive. It will continue to be restrictive, although the level of restrictiveness will come down over time, which is what I would expect. So I would expect that level of restrictiveness to come down to a point where it goes more neutral. But I think you have to judge that in context. Just to give you an example of that in the UK economy, the level of household and corporate debt in the UK economy is actually lower than we would have expected it to be, but based on past experience. So again, that feeds through into just how restrictive policy is at a given interest rate. It's somewhat less restrictive, probably, than it would have been historically.
Could I ask all of you actually thoughts on the neutral rates? Chair Powell.
Thoughts on the neutral rate? So I think, there are countless empirical and theoretical ways to derive it. At the end of the day, I think I like to look at the economy and ask whether our policy stance is having the effects we expect and want on the economy. And to me, I would say we're somewhere probably modestly restrictive at this level. And by some formulations, we're more restrictive than that. But if you look at the economy, growth has been solid. The labor market is solid and still at historically low levels of unemployment. It's not an economy that feels like it's suffering from very tight monetary policy, but I would say that policy is still restrictive.
President Lagarde?
I would say that it's a nice concept, it's interesting, and many of the terribly talented and brilliant economists in this room actually are delighted with discussion about the neutral rate. But honestly, as we're getting closer to target and to where we should be, or are where we should be, and I don't want to pass judgment on that, I think that discussion becomes less relevant. I think what our staff at the ECB measures is leads us to believe that it is higher than where it was before the great financial crisis, but it's relatively low as well, compared, for instance, with what the US neutral rate is at the moment. But it's, in a way, it's a bit of an illusion to discuss that at the moment, because the neutral rate is normally defined in a world where there is no shock, where you have perfect equilibrium. Now, are we in a world with no shocks at the moment? I don't think so. So it's nice to have as a concept, nice to elaborate on it, nice to do research on it, but to use it at the moment where we are as a guiding principle to where we should be, I don't think is particularly appropriate.
Andrew Bailey?
Well, that sort of continues what I was saying earlier. Again, I don't use it as a sort of a guide to where policy should be, but I think this whole concept of restrictiveness is, of course, critical to our judgment, because that's critical to the transmission mechanism of policy, which we have to judge every time we meet. So that's a judgment that, in a sense, we renew every meeting we have. I think I'd rather agree with what Jay was just saying. I think in our case, policy is restrictive at the moment. It's going to become less restrictive based on the curve that we've got in the market. That's what I would expect. We will judge it each time.
Governor Ree? Similar?
I have nothing to add.
Yeah, how would you see it, Governor Ueda?
Yes, so we also estimated something like the neutral rate a number of times. But the range of estimates is very wide. So, but at least we think we can say that the current rate is below neutral. But other than that, I would refer to what Jay said a year or two ago in the Jackson Hole conference, which was like, we are guided by our stars, but under cloudy sky.
President Lagarde, can you talk to us about scenario and why this is, because of the shocks and actually the changes that are going very fast, why scenarios make more sense as a template of the economy?
Oh, okay. So this is a topic that we have largely debated as part of the strategy assessment that we conducted in the last year. And I think, in fairness, the baseline, which is the essential projection on which we work and we determine our monetary policy stance, holds and is decisive in our consideration. But at the same time, our staff has, I wouldn't say forever, but as long as I know myself, has always conducted scenario analysis, sensitivity analysis, in order to arrive at the most solid baseline. It is probably the case that we will do more of it, more systematically, that we might publish more often than we have. We have published, I think, in the last few years, in four circumstances we have published scenario analysis. The invasion of Ukraine was one, COVID was one, the oil crisis as well, and the tariff threats. So all those were exogenous factors that were sort of hitting our screens. I think we might do more scenario analysis that will be looking at the longer-term trends that will affect our economy, and that will inform and strengthen our baseline, enhance it probably in its reliability. So that's what we are debating at the moment, how this is built, what assumptions we make, what choices are decided in terms of publishing will be determined by the Governing Council in good intelligence with our staff.
Yeah, and Jay Powell, on scenarios?
So for many years, we have used scenario analysis internally, and I personally find it very useful. I think many of my colleagues do too. You have just many different kinds of scenarios. We have 6 or 7 at every FOMC meeting. They're often the topic of discussion among governors and at the meeting. We have not taken the step of using them as a public communications device. And that's a big difference. So that's one of the things we're going to be talking about this fall. We will wrap up the first part of our framework review, which is the consensus statement, our monetary policy framework, we expect to by the end of the summer. And then we're going to use the fall meetings to look at communications ideas, and that's one of the ones we'll look at. I will say it has a lot of appeal and a lot of questions, and so my expectation is if we're going to do something in that area, it's going to be putting a toe in the water and not just throwing ourselves in, over Niagara Falls on it. So I can imagine a situation where we would try that in a particular circumstance, but for us, we're just going to do the work and understand it, as many other central banks are doing now.
In our case, we use the scenario analysis in our risk management section as a kind of representing the tail risk. But I have to read the ECB report, but if we have to move that section into the more forecasting section for public communication, I wonder whether it's going to be easy to get some consensus, which scenario we have to do it among our probably members in the monetary policy meeting. So because that scenario and those underlying assumption may be much harder to communicate, to agree among the members. And also, it's specific to us, but how I can differentiate the previous approach of risk management section to the focusing that I have to think over what we have to do.
So I think 2 things I would add, and it's very much in the same spirit as colleagues. One, we introduced 2 scenarios in the May round and in the May report. For me, they were very useful. They were either on either side. They weren't symmetric, by the way, but they were on either side. For me, they were very useful in terms of my decision making because they helped me to answer the question, given the uncertainty. If I'm wrong in my judgment, how wrong am I going to be? Do I think I'm going to be? And what would be the consequences of that? And what would we then have to do to deal with them? I mean, is it manageable? And that was helpful. And then I think the question, coming back to what Jay was saying in terms of public communication, I mean, this is the big step, I think, and it is challenging. I'll tell you why, because I say this quite a lot. We make a lot of conditional statements. You may have detected this in all the many interviews you do. And I'm not making a personal comment now, Francine, but a lot of those conditional comments get immediately translated as unconditional comments. It's sort of life.
We're quite careful, but
no, it's not personal. This is the general point. And so the reason I say this is that if we, and that's about the central case, by the way. So if we introduce scenarios, that's a message to us that you're going to have to do this very carefully in that world, because to get the point across about there is always a range, there's always uncertainty, there is always risk. How you calibrate those and how you, as Jay was saying, how you communicate those publicly is critical, but pretty challenging, frankly, in that environment.
Governor Ueda?
Yes, we also carry out many simulation exercises about scenarios, but we have not, as far as I know, published them. We do discuss in our quarterly reports qualitatively what risks we have in mind. Mm-hmm. On top of that, I would say, in a very rough way, we are carrying out something like a risk management approach to monetary policy making, which is probably a bit similar to what Christine was talking about yesterday. I can't come up with a good example, but risk scenarios, thinkings about tail risks, sometimes do affect our monetary policy making.
Can I ask you all about the dollar, everyone's favorite subject? So when you tune out noise, right, of the past few months, what has really changed about the dollar? Governor Rhee, are we really seeing some sort of paradigm shift in the status as a reserve currency that means historians will look back on 2025 as some sort of pivotal year?
I don't think so, especially in case of Korea. Our Korean won has appreciated significantly in the last 2 months, but I think it's mostly due to the very unique situation that we had. We had a very unexpected, unnecessary martial law declaration in last December. And after that, this political risk, together with the slowdown of our economy, really make Korean won depreciate much more than our fundamentals explain. So in some sense, the appreciation that we have observed in the last 2 months, in some sense, normalization of our, our currencies. And as for the kind of long-term shift of the dollar sentiment, we have discussions, but looks like people are talking about it. But at this moment, they keep the dollar assets while they're increasing the hedge ratios. So at this moment, I think the lion's share of the impact, BIS report show this one is impact is mostly moving from the unhedged to the hedged positions. So we have to see what will happen in the future.
Yeah, Governor Bailey?
Well, I'd say two things. First of all, I think that it's important to bear in mind what the sort of the definition of a reserve currency is and how it's evolved over many years. So I like John Ray. I don't see there being a sort of a major shift at the moment. Not least because in this day and age, the definition of a reserve currency has as much to do with the supply of safe assets into the market that can be used for all the purposes of sort of collateral and security that they are, as much as it is about a sort of pure exchange rate. So I think we're a long way off that change happening. The second thing is going back to something Christine was saying earlier. I mean, when we look at financial conditions, which we do, of course, but I do think particularly, I always believe this, but I think it's even more relevant at the moment to unpack a financial conditions index. And the reason I say that is because we've seen a breakdown in the correlations of the components of a financial conditions index. So you look at sort of bond yields, you look at exchange rates, you look at equity risk premium, for instance. Those correlations are not the ones that we've tended to see established over time. So you have to look at it much more carefully. There are stories, to my mind, about each of the components of that. So when I look at the exchange rate, I look at it very much on that basis. I don't think it's sensible to sort of pack it all up as we normally would and say it's all behaving normally, because the correlations are not actually.
Governor Ueda, there's also many colleagues at central banks, I guess, around the world are building up gold reserves. Is that the only real alternative to the dollar?
I think it's up to a certain extent what areas like Europe or China would do in terms of improving the efficiency or convenience of their currencies, like the kinds of things we were discussing this morning, capital markets integration, and these things will change the degree to which the role of the dollar may decline in the future.
Madame Lagarde?
I think, I don't know if 2025 will be a pivotal year. I would tend to think that, yes, it might very well be. But for a major change to occur will take a lot of time and will require a lot of effort. And I completely agree with the points made by Andrew about the dichotomy that we're seeing at the moment. And that might be an indication of the fact that investors are looking at options. This is what investors are saying. They ask questions, they seek alternatives, and whether that translates into a general lack of confidence that will be further fueled by more uncertainty, more unpredictability, a bit of a jump in the unknown on several fronts, not just monetary policy, not just even the economics, but beyond that, in terms of security at large, for instance, I think remains to be seen. It's not going to happen just like that overnight. It never did historically. There is no reason it should now, but there is clearly something that has been broken, and whether it is fixable or whether it is going to continue to be broken, I think the jury is out on that front.
And Chair Powell, how do you think we'll look back on 2025?
So you're asking me how we're going to look back on 2025.
Yeah, how will historians look back on this year? Is it pivotal?
It's clearly an important year. There's a lot going on, with trade, and I think I'm hopeful that we'll look back on it as a year where we successfully challenged some significant economic changes, and our job is to make sure that is the case.
You get attacked by the president a lot on a personal basis. Does it make your job harder?
I'm very focused on just doing my job. I mean, there are things that The things that matter are using our tools to achieve the goals that Congress has given us: maximum employment, price stability, financial stability. And that's what we focus on, 100%.
Madame Lagarde, if you were in the same position as Chair Powell, would you do anything differently?
I think I speak for myself, but I speak for all colleagues on the panel. I think we would do exactly the same thing as our colleague Jay Powell does. The same thing. Yeah. Right?
Yes.
Governor Bailey, is the rest of the world decoupling from America but pulling tighter elsewhere? How do you see fragmentation happening?
Well, fragmentation, were it to happen, in my view, is bad for activity in the world economy. No question about that. I mean, if we reduce the openness of the world economy, that will be bad for activity in the world economy. Now, I temper that in one respect, because obviously we have learned a lot about the robustness of supply chains over the last 5 years, and it is, of course, appropriate that there will be adjustments to that. But if we see a breakdown of the openness of the world economy sort of beyond that sort of resilience that we do see as needed, then that's bad for activity, it's bad for the world economy, and that I'm afraid, is something that I think we need to be very clear. I've said a number of times, look, there are reasons why this is happening. It's not right to just go around saying, this is all wrong, there are no reasons why this is happening. What I think is very important is that we get back to a governance of the world economy where we can address these issues in the appropriate multilateral fora, and get to the question of what lies behind these issues, what's at the root of these issues, what exactly are the issues, and what do we do about them. And I can't emphasize this enough, that I think it's an obligation for all of us who are obviously very heavily involved in the governance of the world economy. We've all got very big responsibilities, to say that is our duty, to get back and to the process of saying, what's caused this and what do we do about it, and what do we deduce are the underlying issues and how do we address them? Because otherwise, say fragmenting the world economy is a bad outcome.
But what kind of fragmentation would it be? Is it, again, are you fearful that the world is splintering irrevocably, or is there a pool that's just moving?
Well, I think if it was a breakdown of trade in the world economy, obviously exactly how that would manifest itself would remain to be seen. But it would be running against a long period now where we've been building the resilience of trade in the world economy. We've been building openness. But as I said, I want to sort of temper that by saying, look, there are issues. I don't think we should say there are no issues. This is all made up. There are issues, and we need to address what they are and work them out. But we need to do that in the context of a commitment to a robust, open world economy.
Governor Rhee, as the only governor here representing a non-reserve currency country, how concerned are you about fragmentation of the global financial system and the risk at the end of the day that the US may be less willing to provide dollar liquidity in a future financial shock?
Oh, no. But I think I mentioned that we are quite vulnerable to the fragmentation. But in reality, as a small country, it's a pity that we can raise our voice, but in reality, we cannot change the course. So we have to probably take it as an environment and to adapt to it. What matters is we talk about economic fragmentation, but for a country like us, the most serious issue is combined with security. And for that issue, let me stop here because I don't want to go further. But as for the dollar liquidity support, as demonstrated during the global financial crisis and pandemic period, the standing dollar swap lines with 5 international financial centers and the 9 ad hoc temporary swap lines for the 9 non-reserve currencies, that was crucial in restoring the stability in the global world. And if another global dollar shortage hits, I believe that the U.S. Fed will extend their swap lines again, which is very important. And but one other problem for a country like us is we know that the U.S. provide ad hoc swap lines as long as there is a global dollar shortage. But issue is what happens if there is our own problem and there is no global dollar shortage. Our understanding is that Fed cannot extend the swap lines in that case, and we have to self-defense ourselves. That is why I think having a adequate, sufficient level of reserves is very important. And recently, thanks to the introduction of the FEMA repo facility by the Fed, actually these reserves become much more effective tool to defend ourselves.
Jay Powell, on fragmentation?
Well, I guess I'll just agree with what Chang Young said, which is, or point out that nothing has changed relative to our swap lines. We still have the same authorities, and we're still prepared to use them in situations where it's within our legal authorities and where we think it makes sense. So that is, we're aware that that's a big contribution that we can and do and will continue to make to global financial stability.
Governor Ueda, how much do you think about fragmentation and the impact this could have on Japan?
See, on the trade side, I think a lot about what will happen to Asia, even Asia excluding China. So this will depend on the relative tariff rates imposed on the region relative to China or relative to other countries. But there's a fairly strong intra-regional trade taking place during the last decade or two. Also, there's new countries like India growing at very high speed. So I hope there's a sufficiently resilient domestic demand in the region to keep the energy of the region alive. On the financial side, I don't have much to add to what other people have said, but it would be important to keep trying a multi-layered approach to things like swap lines. We have Chiang initiatives in Asia. Doing something similar or continuing to do something similar would be important.
Madame Lagarde, you've often spoken about the role that Europe could take in a fragmented world. How do you see that developing in what kind of time frame?
Well, I think Europe has witnessed in the last 4 years, in particular, well, since 2022 in particular, the last 3 years, major challenges to its way of doing business, to the assumptions that it has made about security, about supply, about destination. Whether you look at what the horrible Russian invasion of Ukraine has precipitated and how that has impaired the sentiment of security that we in Europe had, and the sentiment that we could, forever rely on the protection of others, that has been impaired significantly. When you look at the energy supply on which some of the European countries in particular, but most of us, have relied upon, namely access to reasonably cheap oil and gas supply from Russia, that has been impaired significantly, and we had to find the resources to respond to that. And whether you look at the business model of some countries where destination was inevitably China in the main, that has already been challenged as a result of the fragmentation that is not just a risk, but which has happened. If you combine that with the technology risk that we could all be under, either because of political determination or because of shortage of supply, whether it's on the front of microchips or rare earth, I think we are in a situation where many of the assumptions have been shaken up, and where we collectively are on the cusp of, I hope, this is my hope, of better taking hold and control of our destiny by making significant structural efforts to be more independent, be more productive, be more autonomous in all these different dimensions. Is it going to happen overnight? Yet again, no. Because on some of those fronts, it takes time, it takes investment, it takes political determination, it takes momentum. And from a pure sort of, as president of the ECB, what we can do on the monetary front is to deliver on our mandate of providing price stability so that the fluidity of factors that is needed, both in terms of capital, in terms of labor, can rest assured that price stability will be within our remit under strict commitment to deliver on our target of 2% medium term. But yes, I think it's a historically. I believe that in a few years' time we will look at 25 of those latest 3 years as significant change in the way in which we conduct our life, our business, and develop Europe. And I hope for the better.
Chair Powell, last year in Sintra, you said that the US cannot run these kind of deficits in good economic times for very long. And then you also said we'll have to do better sooner, something sooner or later, and sooner will be better than later. How's it going?
So, of course, I probably preface that by saying that we don't comment on fiscal policy. That is the one thing that I have said, and my predecessors have also said, and that is the U.S. federal, fiscal path is not a sustainable one. The level of the debt is sustainable, but the path is not, and we need to address that sooner or later. Sooner is better than later. That's what I said last year. There's not a lot more I can say.
For everyone else, how much of a problem for the world are America's public finances? Governor Rhee?
We have to see what's going to happen. Yeah, but as I mentioned, we take it as environment, and we just adjust our policies accordingly.
I don't comment on our fiscal policy, let alone anybody else's.
Anyone else want to take that question? Last year, Governor Ueda, you spoke 2 years ago at this ECB conference. It was your first public appearance overseas after taking the current role in April 2023, and you talked about your surprise with the tight schedule of a central governor. Are you getting used to the schedule? Is it ramping up? Is it even more than when you started?
It's still very tight.
Is it tighter than before? How are you finding yourself after more than 2 years in the job?
It's as tight as 2 years ago.
So it hasn't changed?
Getting used to it a little bit, yes.
Governor, what's your biggest task for the rest of your term until 2028?
Well, as I was saying at the outset, headline inflation is above 2. Underlying inflation is below 2. I want both to converge to 2% by the time I leave my office.
I think you were also asked what keeps you awake at night in Washington in October, and you talked about the pace of rate hikes as one thing. Is it still the same, or do you have other things that you're worrying about?
Let's see. I didn't sleep well last night. There's a reason for this. Governor Yi was sitting next to me during dinner, and he told me that espresso contains less caffeine than coffee. So I immediately had a cup of espresso.
I meant the total amount of caffeine rather than caffeine per ounce. Okay.
Anyway, this is a joke. But during these international meetings, I get chances to talk to my colleagues, get a lot of useful insight. So when I go to bed, I think about those and say to myself, maybe I should adjust our economic outlook, our policy strategy in response to these nice comments. And these keep me sometimes awake, but it's a nice thing to do to keep the trust in ourselves, which is the very foundation of what we do among central bankers.
To all of you, what keeps you awake at night, given all of the uncertainties and the changing world? Madame Lagarde.
First of all, I can confirm what Kazuo just said, because it did happen on occasions that the following day, after probably a difficult night, you came to see me and said, did you really say that yesterday during the meeting? And I knew that you had been sort of ruminating and pondered what the consequences were. So it's the truth. It's not a joke. Yeah. What keeps me awake? The truth. By that I mean I'm getting more and more concerned about the role that artificial intelligence is going to play, about how distorted things can be presented, how public opinion can be manipulated, and having been a lawyer by background, where searching for the truth is one of the purposes that we hold as auxiliary of justice, I'm very concerned by what's happening at the moment and what kind of moral compass and the watchdog of the integrity of data, because we keep saying that we are data dependent, and we are, and we want to see, our projections and our assessment and the analysis anchored in empirical data and understanding of what's happening in the reality of the economy. And I do have this fear that things can be distorted and that we can fall prey to that, because it's incredibly easy and actually described now in some literature. That is of great concern to me. I mean, I sleep at night, but.
Chair Powell?
So I have a little more than 10 months left on my term as chair. And all I want and all anybody at the Fed wants is to deliver an economy that has, price stability, maximum employment, financial stability. And what keeps me awake at night is how do we get that done? I want to hand over to my successor an economy in good shape. And so do all of my colleagues. That's all we ever want. So that's what keeps me awake at night is are we on a path to do that, and how do we get that done?
Do you plan to stay on as Fed governor after your chair term expires?
I have nothing for you on that today.
Governor Rhee, what keeps you up at night?
First, my apologies to Ueda-san, but to me...
Scores on the espresso will be settled.
One concern that I have is unique to our problem is a perception gap of the public due to very rapid structural changes. For example, a decade ago, our potential growth rate is around 3%, but now it's well below 2%. But people still think that we have to grow above 3% in normal times, and that actually expedite their demand for the more stimulus monetary policy and fiscal policy, while what we need is a structural reform. But on the other hand, if I keep on talking about structural reform, I don't know how far I can go on discussing this structural issue, because some people say that it's well above my mandate. But I think what is important for our country is not only the cyclical issue, but how to adapt to these structural changes. And that is a very difficult challenge.
Governor Bailey?
Well, I want to deliver inflation sustainably at target. As I keep saying to my colleagues, can you please stop thinking of all the shocks that we haven't had yet in my term that we might have. But today's, maybe I've been sleeping too well, because I felt I needed something else to do, because today's a significant day, because it's my first day as chair of the Financial Stability Board after taking over from Klaus's enormously distinguished leadership. And so that gives me a whole load of other vulnerabilities to think about and worry about when I haven't got anything else to do. But seriously, there obviously are issues in the financial system that we're very focused on and will be very focused on in terms of understanding the vulnerabilities of the situation we're in.
Governor Rhee, I also wanted to ask you actually about digital currencies, because the Bank of Korea put brakes on testing a central bank digital currency this week. Would you agree that it's more of a priority to find, I guess, the right regulation for the immediate challenge of stable coins than to develop a CBDC that no one may use?
That's a hot topic now in Korea. Surging in the dollar-denominated stable coins, especially recent passage of the Genius Act in the United States, make many fintech companies and advocates of the stable coins to ask the government to allow the non-bank institutions to participate, to issue the Korean won-denominated stable coins. As you mentioned, that we have been experimenting the tokenized deposit pilots with a commercial bank in our permission network. But I think that given the surging demand for allowing non-bank financial institutions to issue stablecoins in public domain, make us a little bit, I have to talk with the government agencies, because it's well beyond the Bank of Korea's mandate. From our perspective, what we are worrying about is that if we allow the unregulated won-denominated stable coin, it will definitely expedite the exchange into dollar-denominated coins and undermine our capital flow management regulation. We don't know whether the critic says that the new technology in blockchain can identify the irregular transactions, do the know your customer rule kind of regulation very well, and then even identify the irregular, strange transaction very easily. But we're not so sure whether this is true. And also, there's a narrow banking issue, many other issues. So I think I have to talk to the government authorities how to handle this kind of regulations.
Andrew Bailey?
Yeah, I mean, it's an important subject. It's one of the subjects that we will have on the agenda for the FSB, no question about that. You see, the thing that I think is about stablecoins is that, and here I distinguish them from something like Bitcoin, is that they purport to be money. They purport to have the medium of exchange, function of money. And therefore, they do have to meet the test of money. We've talked a lot about this. We've talked a lot about trust in money, about the so-called singleness of money, which is really all about them being assured to hold their nominal value. And for me, this is going to be the critical test as to what structure and design comes out of all this work that meets that critical test. Because if they don't, then I don't think we can be content with them. And if they're purporting to be money but don't actually meet the test of money.
Christine Lagarde?
I have a relatively strong view on that point, if you don't mind, because I think that we are falling prey to some confusion between money, means of payment, and payment infrastructure. And that is accelerated or emphasized as a result of the technology that are being used, and some technologies in particular. And I regard money as a public good, and ourselves as the public servants in charge of securing and protecting that public good. My fear is that blurring of the lines that I mentioned earlier are likely to lead to a privatization of money. And I don't think that this is the purpose for which we've been appointed to do the job that we have, nor is it good for this public good that is money. I think it risks undermining our capacity to conduct monetary policy, and I think it's risk weakening the sovereignty of those countries or those regions which inadvertently become subject of the use of that means of payment infrastructure / alleged money, and we should not only just consider it, but determine what our policy should be about it, if we mean what we say and we protect what we have to protect. Thank you.
Chair, I actually have a question. Do you fully support the recent proposal driven by the Vice Chair for Supervision, Michelle Bowman, on rolling back capital rules? Would that actually meaningfully improve liquidity in the Treasury market?
I do fully support what we in fact voted for, what we put out for comment, which is sort of putting the leverage ratio back where it should be, which is a backstop to risk-based capital. And so yes to that question. Let me say on stable coins, if I can.
Yeah.
I do share the concerns that you hear here, but I also think it's a positive step that we don't have a regulatory framework for these now in the United States. We tried very hard in the last Congress to work with people on both sides of the aisle to create such a thing. Now it looks like we're well on the way to creating a framework, which I think is something we need. If we're going to have stable coins, and apparently we need to have a federal and state level regulatory framework, which I think we're making progress towards having.
We only have a couple of minutes left, and so many of you have plenty of time left in office. Others will leave sooner. Knowing what you know today, Governor Ueda, if you already had to offer some advice to your successor, whoever that may be, what would it be?
I don't know. If I finish in 2.5 years or so, maybe, as I said, inflation would be at 2%, but I will not have finished reducing our balance sheets to appropriate levels. So I would say to my successor, take great care in proceeding with further reduction of the balance sheet, size of the balance sheet.
I like that. Christine Lagarde?
I don't think I would say anything, because I remember my predecessor telling me that it would be a walk in the park. So that's a nothing. But I would share the ambition of Jay Powell. I would want to hand over, job as well done as possible and results achieved as much as possible.
So quickly, we're trying to deliver macro stability, financial stability, economic stability for the benefit of all of the people. If we're going to do that successfully, we need to do it in a completely non-political way, which means we don't take sides, we don't play one side against the other, we stay out of issues that are really not our bailiwick, and we just focus on those things. Really, we're trying to have it be so that the public lives their best economic lives, and so elected policymakers can make the really important decisions in a stable environment. And so that's how I think about it.
Governor Rhee?
I can say something, but I don't know whether my successor will take it seriously. But given that I mentioned structural issues, I hope that the Bank of Korea continue to raise voice outside of just monetary policy for general economic issues.
And Governor Bailey?
Be humble. So we're exercising real power. Many people think we are not humble. Be humble. And I'll say this, if you want an illustration of this, Christine and I were both in Ukraine the week before last. If we think we have it difficult, spend time with the Central Bank of Ukraine. Nothing.
Yeah. Thank you so much to everyone for a wonderful panel. Thank you.
Thank you, Madame. See you soon. Great talk.
Thank you to Francine and to all of our panelists for doing such an excellent job of bringing today's first day of Sintra to a fitting end. For those of you in the room, just 2 pieces of housekeeping. We'd like you all to vote on the Young Economists competition. To do so, please go outside into the foyer. There's QR codes on the posters. Click on them and then use the code on your badges to choose your favorite entry. And then please come and join us downstairs for the group photo too. And for those of you watching online, thanks a lot for joining us, and please join us again tomorrow morning for day 2 of Sintra.